And in the normal times, we would have had it as a sort of a get-together with the members, interacting formally, informally, everything. Anyway, when the budget goes paperless, it's only natural that the workshop goes virtual. We are happy that we are able to do that. So I would request Mr. Shivatsram, President, Madras Chamber of Commerce and MD Wheels India, to give his opening comments and kickstart the workshop. Just before that, two administrative announcements. I request all of you to be on mute when you are not talking, both the audio, video, if possible. And also, your questions, if any, could be posted in the Q&A. So we will, after the opening remarks by the President, we will have the keynote address by Dr. Ajit Ranade, and then we will have the technical sessions. End of that, we will take the Q&A. So I would now request Mr. Shivats Ram to take over and give his remarks. Mr. Shivats.
Thank you, Saraswati. Good morning, ladies and gentlemen. It gives me great pleasure to welcome all of you for our post-budget session. Today, it's a great pleasure for us to have our keynote speaker, Dr. Ajit Ranade, Chief Group Executive President and Group Chief Economist, Aditya Birla Group. We're privileged to have you, and I do know this is a very busy time, pre and post budget for economists, and so thank you very much for allotting time for us. We're also particularly pleased for you to address our members today to give a unbiased perspective from economists. You're what we call a 365-day economist. Most of us are economists for this 1 week period, pre and post budget. So we would like to hear your views, as I'm sure a lot of our views are biased and uninformed. It's also a great pleasure for me to welcome our team of experts, Mr. K. Vaitishwaran, Mr. Sriram Seshadri, Arvind Srivatsan, Mr. Vikram Vijayaraghavan, and Dr. M.R. Venkatesh, members of our General Committee, past presidents, and all the members and invitees and attendees who have joined us. Dr. Ranade, I thought we'll also give you a little brief about the chamber. The chamber is the second oldest chamber in India. I think it was formed a week or two after the Mumbai chamber. We were established in 1836, and we've been an integral part of commerce and industry in the state ever since. We are now in our 185th year, and the job that we do is actually form a connect between industry and government. We're very involved with the government, both in resolving problems that members have, but also in terms of policy making. Our inputs are sought by the government, and they have looked at us, at least over the last few years, as a very unbiased voice of industry. And very often we get pulled in directions which are determined by the priorities of the government. To keep in touch with the changing times, we also have a number of programs for our members, like what we call food for thought deliberations on topical subjects. And we have also been involved in various initiatives such as the Sustainable Chennai Forum, where we've tied up with UN Habitat. Recently, as part of our job of facilitating membership and business, we have also inaugurated our exclusive arbitration, mediation, and conciliation center for services to our members. The chamber has always been very interactive in getting information and input from our member industries, giving the pre-budget memorandum to the government, and having sessions both prior to the budget and also post-budget. This has been part of our heritage, where we've been doing this for more than 2 decades, at least. And during these post-budget sessions, we typically have called people from the government or economists or ex-government servants to deliberate on some of the changes that have taken place. The FM presented the budget on the 1st of February, and I think there was so much of talk about what could happen that we had prepared ourselves for the worst. and in a sense, the bubble burst, and it probably is looks brighter than it probably is, because of the fact that our expectations were kept at such a low level prior to the budget, and we were anticipating taxes and other such things, and it's a tight uh, fiscal for the government, so the ability to put money in was a concern. We were worried about, they're trying to use a fiscal deficit as a mechanism to prevent spending money. And I think lot of those bubbles have burst. And I think most importantly, given the fact that we had kind of fallen into a hole uh, during the COVID period, with the pandemic hitting our economy, and negative GDP growth in the current year, I think the fact that they're spending on infra, uh, healthcare, some of the obvious areas, I would say obvious, but it hasn't always happened in India that the obvious things happen in the budget. So their focus in these areas is definitely, I think, a big plus for industry, and at least gives businessmen confidence that going forward, things will improve. In addition to that, I think there's a lot of work which has also gone in the financial sector. I think, first of all, the asset reconstruction company, they talk about privatization of a couple of banks, insurance company, and any non-strategic government entity. I thought was a very big announcement from the government, as also the rationalization of the securities code, where they want to combine all these various codes together and come up with one, and no doubt also add a lot of features into that. So I would say that, broadly speaking, talking to our members, our reaction has been positive, but we do have a lot of experts in our membership, especially on taxation and other areas, and I had to keep them on mute the day of the budget. And I'm sure there are a lot of points we'll hear that we have missed between the fine print. And I'm sure that Dr. Ranade and our experts from the chamber will enlighten us sufficiently to bring us more down to reasonable level post our euphoria after the FM speech yesterday. So, welcome all of you once again to this budget session, and thank you very much. Look forward to the interactions today. Saraswati?
Yeah, thank you so much, Mr. President. That is the collective view from the chamber as a primary kind of an observation. We know we are going to get a lot more insights from Dr. Ranade here, probably a 360-degree view. And as he said, we don't know whether the devils or angels are in the details. We will wait to know about it. Let me quickly take the pleasure of introducing Dr. Ajit Ranade today before this audience. He is the Group Executive President and Chief Economist of Aditya Birla Group. And the group has, as you know, operations in more than 40 countries with head office in Mumbai. The group's business includes metals, mining, chemicals, textiles, cement, telecom, retail, a gamut of field and sectors, I should say, and of course, asset management too. Dr. Ranade is the member of the Economic Policy Council of the CII and a member of the National Executive Committee of the FICCI, Federation of Indian Chambers of Commerce and Industry. He is the chair of the Research Advisory Panel of the Indian Institute of Banking and Finance and member of the Governing Council of CAFRA of the Reserve Bank of India. He is a board member of the Gokhale Institute of Politics and Economics and member of Academic Council of Meghnad Desai Academy of Economics. In the interest of time, I am keeping his introduction short, but we would be happy to hear a lot more from you, Dr. Ranade. Over to you now.
Thank you very much. Thank you for the kind introduction, Secretary General, Ma'am Saraswati. And thank you to President Shri Vatsram for his kind words and introduction. Thank you for Madras Chamber of Commerce for inviting me, and thank you and compliments to the committee of experts. I think Dr. Venkatesh will recognize we met many years ago, and indirectly we have been one or two shake hands away from each other. And good morning to all of you and all the participants. So 1836 turns out to be very, very landmark year, and I'm happy to know that Madras Chamber and Bombay Chamber, by the way, they are still called Madras Chamber and Bombay Chamber, are just almost like twins. And as you said, 186 years old, 185, 186 years old. So much older than the Republic, much older than this century also. So a lot of wisdom and experience and heritage. So I'm very happy and privileged to be invited today. I'll just speak for the next 10, 15 minutes. I don't know what the format is, and I'll share my thoughts. Of course, the experts will probably analyze the budget with much more forensic expertise than I have, and I'll just give you my some of my thoughts, share some of my thoughts. But before we come to the budget, I just want to step back and examine what was the macro context. And I need to go back even before the pandemic. So if we were having this meeting sometime in February or January 2020, I would have to remind you that the economy actually had been on a downward path for almost 3 or 4 years, starting with 2016-17. So 16 November was the demonetization event. Since then, the economic growth officially reported by Government of India was coming down from 8 to 7 to 6 and then to, I think, 4 or something. Of course, during this year, it's -7, which is economy has contracted. So that is first point to note, that we were not in a comfortable situation even before the pandemic. Second point, our export growth. Exports are very much intertwined with industrial growth. Since this is Chamber of Industry, we are concerned with industrial health. So our export growth from India, merchandise exports, over the 5-year period, up to 2019 or 20 also now, has been growing at a net rate of 0%. So our exports at the end of 5 years is the same as what it was back in March 2014. So that's second year of concern. Third point is that if you look at the investment to GDP ratio, you see the economic growth happens because we invest today. When you sow your seeds, or you have a cornfield, or sow your crops today, tomorrow in the next year you sow the seed, you harvest the crop. Same thing with investment. Investment today is output tomorrow. Investment today becomes income tomorrow. Investment today becomes employment tomorrow. So investment is a very critical determinant of economic growth, and investment to GDP ratio is something that economists like to see and follow and examine. Investment to GDP ratio had been falling and was stagnant. It was at a peak of something like 38%, but that was 10 years ago. But in the last 4-5 years, it's been stagnating at 28%. And then the fourth thing. So I'm just recounting some 4 macro indicators before even the pandemic began, which is GDP growth trend, export trend, which is, as I said, related to industrial growth. Thirdly, investment to GDP ratio, and fourthly, the health of the banking sector. And one of the indicators of the health is the non-performing assets. That is the bad loan ratio. Now that has also been steadily going up. Actually, it so happens that actually between 2019 and 2020, in those 1-year period, in fact, the banking NPA ratio improved, but it was still high. It was close to, I think, 9 or 10%. Now, some of it came down because there were massive write-offs. See, what happens is when there is a delinquency, when the bank, when the loan goes into default after 90 days, then the bank has to start provisioning. Beyond 120 days, it was required to go compulsorily to bankruptcy court, but that has changed because of Supreme Court judgment now, and the bank has to start increasing its provisioning. After some time, the bank has to make a decision whether to write off the loan completely. The writing off does not mean that the recovery process stops. They will continue to chase the defaulter, but the write-off happens. So what happens is when the write-off happens, the NPA ratio actually goes down. In fact, it improves because now it's no longer a non-performing loan. So NPA ratio had improved, but only because I think write-off. So that is the fourth thing to worry about, NPA ratio. That is the banking sector health was in considerable concern. Now after that comes the pandemic. After that comes the pandemic. Of course, we don't have time today to discuss why these things happen. I'm just giving you the data. I'm giving you the macro indicators. This is not the time for us to say, like I think Buddha said, when the house is on fire, we don't start asking each other, hey, who's put on the fire? Who's the culprit? We take a bucket of water and start dousing the fire. So I'm saying, I'm not saying the economy was in fire kind of distress, but basically the trend over 3-4 years was that we were seeing these macroeconomic trends going down. And then came the pandemic. Just so that if you think that I'm only pointing out the worrying points, there were, of course, the positive points as well. For example, the inflow of foreign funds, what we call FDI or FII, or even private equity. All those foreign funds were coming in quite healthily. And before March, before the pandemic event happened, the stock market was doing very well. And of course, we are back to those exuberant days today. I would say the structural reforms, which I think President also mentioned, insolvency code and all that were in place. So of course, there were some things which were going right. And but from an economist point of view, I think if I were a policymaker back in January 1 year ago, I would have been worried what to do. What should we do? What should the strategy be? Then came the pandemic, which was like a triple shock: a supply shock, a demand shock, and a wealth shock. A wealth shock because the stock market crashed by 50%. Demand shock because suddenly the demand for things like travel, footfalls in malls, retail, tourism, everything went down sharply. And supply shock because factories were closed, lockdown period. Now the wealth shock, slowly the stock market has started reviving after, I guess, August or so. Supply shock, once the lockdowns were starting to be relaxed, so factories started reopening, especially manufacturing businesses, the large businesses like construction materials, cement, steel, chemicals. Some of them, they've started reviving. Demand is also coming back. We saw it during the festival season, and some of it was, people call it pent-up demand. People really are, after being locked up for such a long time, there's something called pent-up demand. But now I think there is some evidence that demand is also building up. But the background still is that, so as Finance Minister Mr. Sitharaman said, this is the first time, I think, in 40 years that the budget is being presented after a recession. The economy has contracted in real terms by 8 or 9%. Okay, so this is, we have to take that into account. So that has been the background. And the bigger worry was that unemployment. You see, unemployment numbers in April were as high as 30%. 30% of the workforce was unemployed back in April last year. Then slowly the numbers have started improving. But what happens is that when somebody loses a job, and as you know, 80-90% of India's workforce is in, if not, you call it unorganized sector or informal sector or unregistered sector. Basically, these are people who don't have unemployment insurance, who don't have health insurance, who don't have pension security, old age security. So all of it, I call it unorganized sector. And so if you lose a job, you gain a job, you sometimes, but the job prospects, you see, even people who are employed are anxious. Am I going to lose my job? There's anxiety. So that, and then you look around. So therefore that starts affecting consumer confidence and consumer behavior and consumer spending. So people start cutting back on discretionary spending. They spend only on essentials. I'm making a general statement. By the way, when I mentioned earlier those 4 worrying points, and I said there are some good points, healthy points in the economy, I should not forget to mention the agriculture sector. So we'll hopefully come to that if we have time. But I'm talking about the state or the anxiety of the labor market. So consumer confidence starts dipping. And when consumers are not spending, industry or producers also start getting nervous. So if you're not seeing demand out there, there are cutbacks on investment plans, expansion plans. There are cutbacks on headcounts. And there is, there's somewhat, go slow. Your supplier payments get delayed. So that is called business confidence. So business confidence starts going down if consumer confidence is not visible. Consumer confidence starts going down when recruitment is not happening or when there are job insecurity. And these two feed on each other. Consumer confidence and business confidence feed on each other, so that pessimism spiral. This is the backdrop to the budget. So more than anything else, what the budget had to do was to inject a level of confidence so that this negative spiral becomes a positive spiral. Consumers start spending, and businesses start expanding, recruiting, and so on. So we saw some of that. If you look at the organized corporate sector results, quarterly results at the end of September, fantastic profits, fantastic, 35-40% growth in profits. But that is somewhat to be taken with caution because the profits were on the basis of lower costs. So revenues did not grow by 35%. The top line grew sometimes only by 5%. But cost, there was a lot of cost compression. And therefore profitability, but profitability is good, means that gives some confidence to businesses. They start investing. And I think the December quarter also continues to show. Let's not forget that we are in pharma, in digital businesses, things are going well. This lockdown and pandemic has been good for these two sectors, healthcare and especially and digital. Today, we should be proud that a company like TCS is the most valuable software services company in the world. Profitability of all the software and digital companies are doing well. In fact, globally also the same phenomenon is seeing. Apple reported a mind-boggling quarterly sales of $111 billion, $111 billion. 111 is supposed to be unlucky in cricket, one lucky for Apple, and it's a $2 trillion market cap company. So digital, some businesses, of course, did well during the pandemic, but that's the backdrop, as I said. So we had to kind of inject this positive spiral between consumer confidence and business confidence. And that's where we come to the budget. So I think the government, what they did is that, as was well articulated in the economic survey, that because there was so much uncertainty about the pandemic, about the virus, about the synthesis of the vaccine, about the strategy, what should be the strategy? It's a triple strategy. First, either you got to have a vaccine to prevent the virus infection, or you got to have efficient treatment so there are less fatalities, or prevention. So vaccine, treatment, or prevention. Prevention means social distancing, wearing mask, etc., sanitization. So this was a learning period. So I think we impressed the world with the way we have flattened the curve, the way the virus spread has been compared to large countries, and compared to the fact that we are still a developing country with high population density. Our record of this virus control has been quite impressive. So initial strategy for the government was not to do immediate fiscal stimulus, but to focus on this aspect, the life-saving aspect. And then, of course, a lot of liquidity was provided. So when Prime Minister announced the Atmanirbhar package back in May, 20 lakh crores, much of it, 90% of it was in the form of new loans, loan guarantees to MSMEs, new liquidity support, mutual fund support, etc., etc. But it was not actual fiscal stimulus. It was not actual money into the pockets of consumers or into the pockets of MSE. That is something we are seeing now. So I think in the budget, basically, Mr. President said, what did he say? He said we were all scared or something on the eve of the budget, that you thought there's going to be a new COVID cess or some new taxes on the super rich or inheritance tax or wealth tax, and how is the government going to pay for all this? I think that was the fear. So nothing, no new taxes. That was the big. So that itself. So I would say the budget, quickly I'll say, I identify four themes of this budget. Number one is fiscal stimulus, which is very obvious. I hope everybody agrees that there's been a fiscally expansionary budget. So all the hesitation that we saw during the pandemic or later half of last year, that why is the government not increasing fiscal stimulus? Though a lot of people were criticizing. Look at UK, look at the Western countries. Why is our government? So that, I think, first theme that I noticed is fiscally expansionary. Much more emphasis on infrastructure. Infrastructure is a sector which creates employment for semi-skilled and unskilled workers. It creates demand for construction material like steel, cement, etc. Roadways, once they're built, highways, the land values adjacent to the roadway increases. So land value increase attracts investment. So fiscally expansive budget. Second, the fear of rating agencies. There was this poem of Rabindranath Tagore, which was quoted in the economic survey, that where the mind is without fear. I don't quite think that that line is appropriate here, but basically the finance minister said, to hell with the rating agencies. We are not going to be afraid of them. They have been unfair to us. Our country rating is lower than countries like Mexico or Argentina, even though those countries have a history of defaults. I think definitely, there's been sovereign defaults, and yet consistently India's rating has been lower, despite its record of no defaults, despite its record of having now the fourth or fifth highest foreign exchange reserves in the country, despite relatively stable macro right now, relatively stable inflation, and stable currency. So the second theme I see is that we are going to have a fiscal deficit of 6.8% or whatever. This year was 9.5%, and we are not going to be afraid. And the fiscal deficit is going to come down to 4.5% in 4 years. So we are not going to pretend that it's going to coming down quickly. And so that was the second theme. The third theme was the P word, privatization. So we have announced privatization of 2 public sector banks. We are going to privatize a government-owned insurance company. We are going to monetize, the fancy word is monetizing government assets, but basically it's allowing private sector entry into the toll roads from National Highway Authority will be transferred to a private operator perhaps. There is also making it easier for foreign funds like sovereign wealth funds and pension funds to participate in investment trusts or real estate investment trusts here, infrastructure investment trusts. So the TDS requirement is gone. So FDI and insurance is gone. So there is a theme. The third theme is that we are going to recognize that private sector has a big role to play in reviving growth, and we're going to make conditions so that we are not afraid of privatization. In fact, the government has said, and the Niti Aayog people also reiterated, that the government wants to get out of all the non-strategic sectors and let private sector have a presence and leave it for the private sector. And the fourth thing, of course, I must say that there are a lot of I'm running out of time, but basically health spending. So small things. And I noticed that health spending, but definition of health includes nutrition and the vaccination drive and everything sub milake. If you include everything, it's about it's gone up almost double. India's spending, public spending on health as a percentage of GDP is actually below its peers. Half, in fact, half. It's not even half of China's. So we definitely need to increase that spending. Not to imply that just spending is the solution. The spending has to be converted into outcomes, the outcomes into actual achievements, and so on, and improvement. Ultimately, we need to see improvement in health. India's ranking in global hunger index, global child malnutrition index is not something to be proud of. So I think this is a good priority. I count health and education as part of soft infrastructure. Just as we are going in a big way for hard infrastructure like roads, ports, highways, and similarly, we need to also focus on hard infrastructure, soft infrastructure, which is especially primary health, primary education, which builds human capital, just like physical capital, human capital. I think that's the direction we're going. And so those are the 4 themes. And apart from these 4 themes, let me just recount again for you. One is that it's finally a fiscally expansionary budget. Secondly, it is not going to be cowed down by rating agencies. Thirdly, it is not afraid to announce that we are going to give a much bigger play to private sector. And fourthly, it is recognizing the importance of social sectors, especially health and education. And apart from these 4, we also appreciate the fact that it is honest and transparent in the sense that they are not trying to hide the deficit into some other balance sheet. Like some of the deficit, especially related to food security, was actually sitting on the balance sheet of Food Corporation of India. So it's good that all of it has been brought and is transparently disclosed. There could be several things to nitpick about. I'm not going to spend time on that because any budget, one very easy and common criticism is that, it has so many missed opportunities. So the set of missed opportunities is an infinite set. So I'm not going to start counting that. But overall, and what is for me to say, the stock markets have given a 21-gun salute. I don't know what the market is doing today, but I hope basically now the what to look for is how this, as I said, this virtuous spiral between business confidence and consumer confidence builds up, so that not only we see the larger corporates and larger companies start investing and expanding, but also it trickles down, or the effect goes to their suppliers, who are typically small and medium enterprises. And this is where half of India's industrial output, half of India's industrial employment, half of India's industrial exports, they come from the SME sector. That's the health to watch out for. And as I said, agriculture has been a great silver lining. In fact, we have record output of food grains this year, as also last year. And the topic of farm laws and that agitation is for some other day, not today. So thank you, Mr. President. Thank you, Secretary General. Back to you.
Thank you so very much. I wish we had more time to listen to you. Thanks for the brilliant talk. If you have time, do you think you can take one or two questions? Or you
Very
open?
briefly, sure. Yeah. Sure.
Okay.
Just one
Mr.
or two, please.
Srivats, President, would you like to?
Yeah, I have a couple of questions, Dr. Anade. One is this the fiscal release that has happened in this budget. Is it likely to affect inflation, and will that inflation itself come back to haunt the government as rates globally seem to be poised for some kind of uptick over the next couple of years?
Yes, there is a risk of inflation. We are seeing the commodities in the world, whether they are non-ferrous commodities like copper and aluminum or zinc, and also ferrous things like steel and iron ore. Those prices globally have been going up quite a bit. And one of the reasons for that is because that high liquidity is going into these commodities as if they are speculative assets. So they are some of them are traded on the commodity exchanges. So we have to watch out for that. But one of the biggest determinant of inflation in India is actually crude oil prices. Thankfully, the crude oil prices are at about 55 Brent, and I think the outlook is stable. That's not good. So I think on that count, the risk is not high. If agriculture production is comfortable and high, food, another big source of inflation for us is food inflation. On that count, also, I think we can be comfortable. And it is also said that around inflation of around 5 or 6% headline CPI is growth promoting. When it goes to 10, it is worrisome, and it can affect the society and the economy adversely. But between, say, 4.5 to 5.5 or something like that, which is where we expect it to be, that actually can be growth promoting, because people look forward to increments. When you're looking at your employees, they want an increment next year. When people when you're a producer and you're selling your goods, you want to price tag, you want to increase it by 5%. So some amount of inflation is actually growth promoting.
Any of the other panelists, please feel free to unmute and ask a question.
Mr. Anade, this is Arjun from Sundaram.
Yeah, hi Arjun. Hi.
How are you doing?
Good. I'm good.
One quick question on the onboarding of the FCI debt that we are talking about. Now, going forward, there is going to be no offloading any longer. Does that mean that every couple of years you will see the revenue expenditure keep bumping up again and again? Is that a risk we are looking at?
So, I was giving an overall, sharing my overall thoughts. So you're now asking me to wear my sharp and tight hat as economist to start worrying about the fiscal sustainability and debt sustainability and revenue deficit. Yeah, this is something we need to figure out, because this is not this food subsidy bill or even all the subsidies. They are not going to be sustainable unless we devise some way to move them from price-based or input-based subsidies to direct cash support. You see, even for the cooking gas, it's better to price the cooking gas cylinders at market value, and to the vulnerable section do a direct cash reimbursement. I think the same thing goes for fertilizer. That instead of having a blanket permission and selling fertilizer, what costs 20,000 rupees a ton, we sell it at 500 rupees a ton. Or 20,000 rupees for so we sell it at 75% discount. It's better that we target the smaller farmers, and it's not an easy job. So the answer to your question, Arjun, is that there's not one solution to ensuring that the revenue deficit comes down. Simultaneously, there's got to be reforms of subsidy, the way subsidy is administered.
Fair enough. Thanks a lot, Doctor.
Thanks. Yeah.
Any other question? Dr. Anade, if I can ask one question. I mean, the one point that was discussed much, I should say, is the MSME. Do you think something more could have been done for them?
Yeah. Madam, I said that the list of missed opportunity is an infinite set. So certainly people were looking for some kind of direct benefit to MSMEs. Certainly. I mean, no denying that some kind of direct stimulus to the consumers as well as MSMEs could have been done. I mean, There's a long list. For example, just before the budget some time ago, we saw that finance minister said that we are clearing, the pending payments, just the pending payments. One estimate was 7 lakh crores. That includes fertilizer, fertilizer payments. See, the fertilizer subsidy is actually reimbursement to the producers. That has gone up to 80,000 crores. But even payments from, and these are payments for bills which are not in dispute. So the invoices have been raised, the services, the goods have been delivered, and these are payments from entities like the railways or public sector corporations or government of India itself or state governments. The estimate is 7 lakhs. So just clearing those pending payments itself is a kind of stimulus. So that, I think there's some focus on that, and each state government should also be asked to ensure that the pending payments, especially to SMEs, should not be more than, let's say, 60 days. I believe Tamil Nadu has a portal actually to highlight, sort of name and shame those large companies who have not yet paid. But that requires the SME person, SME supplier to report to the portal, and this doesn't always work because the SME person says, I'm going to displease my customer, so I will lose the business forever. So somehow or the other, they keep going, the delayed payment. So that's a hard problem to solve. There is also this thing called trade platform. Is it trade or the TREA trades platform, where the receivables are, if I'm an SME, I have some payment which I receivable. I can put it on the platform which is supported by RBI and the Government of India, and then start selling. It's called bill discounting, but it's done in the exchange form. So I'm sure more can be done that's where most of the action is. Employment, output, exports, all action happens at the MSME levels.
Any other question from anyone? I think he's also running short of time.
Yes,
I know that. So very big thanks on behalf of the chamber. Mr. Srivaths, you want to say something? Okay, I'm not seeing him. Thank you so much.
Thank you, Dr. Ranade. So, sorry, I was fiddling around with my mute and unmute.
Thank you very much. Thank you for inviting me.
Yeah. Thanks a lot. Thanks a lot for your wonderful address, sir. I think against the 6 pillars FM said, you have really brought out the 4 themes, and that's really wonderful, and more for us to deliberate in the following sessions. A big thanks to you again for joining us today.
Thank you, sir.
Thank you. I think we will now get into the nuts and bolts of the budget with all our experts around. Can I request Madhumati to introduce our experts and then take the discussion forward? Madhu?
Ma'am, thank you. I am Madhu here. I'm the Deputy Secretary of the Chamber. I'm privileged to introduce the speakers. First, we have Mr. Vaidishwaran. I do think he needs a big introduction. Anyway, that's his sake. He is an advocate and tax consultant and a law graduate. He holds additional qualifications from the Institute of Cost and Wealth Accountants of India and Institute of Company Secretaries of India. He has over 29 years of experience in handling matters of multinational major corporates all over India in advisory capacity, as well as to appearance before appellate authorities, tribunals, and courts in corporate law and tax matters. He has authored books on VATs and VAT and indirect taxes, and is a faculty in indirect tax GST in many institutions. His latest book is The Taxation of Digital Economy, available on Amazon. Apart from holding various positions in different organizations, he is the chairman of the Expert Committee on GST of the Madras Chamber, and he is a general committee member. So we have Vadi coming for a presentation on the analysis of indirect tax proposals. Or did I say it right? I meant Mr. Vaidi. Over to you, sir.
Thank you. Swarna, can you get the PPT running? Good morning, all. And while content keeps coming, it's a pleasure to be part of Madras Chamber's flagship budget analysis this year. And it's equally a pleasure to share this platform with my friends Sriram and MR Venkatesh and the new young Turk Vikram and Arvind, who's an old friend of mine. And all of them have phenomenal insights onto the budget, and they'll probably give you why certain things have come and why certain things are structured in a particular manner. So this should be a very interesting and technical session. And knowing Madras Chamber, which is my favorite platform for budget, I always try to structure a presentation which is a combination of tax and something else. So each year I have a theme, And this year also, even when I was thinking that I should just do an ordinary presentation, I got a couple of calls from clients saying that, what is the theme that you're going to do this time? So it looks as if the agenda is set, and therefore I've decided to work on a theme. Next, please. I have to lay down these disclaimers. So the first one is a simple one. It is now, of course, confined to the time limits given by the chamber. During lockdown, all of us have been very busy in different ways. There is an element of work from home, no doubt about that. But apart from work from home, all of us have also ensured that none of the series that have come out in the Netflix or Amazon or Hotstar or anything else has been missed out. So people have been very, very active. At least I have been active. Many of my friends in the panel are also equally active. So this presentation is going to use all the content titles, and I have to give a standard disclaimer. These are not advertisements for them or endorsements for any of them. Just to add a little bit of bit. And all SOPs were followed while making this presentation. And I think the panelists also hinted that it will be a series of budgets. So don't be surprised if there are further tools come in the next few weeks in terms of changes. And my last favorite disclaimer is that understanding amendments is injurious. Next, yeah, stay here. This is what our Dr. Ranade beautifully mentioned. He not only talked about the fact that the government had to deal with the COVID-19 calamity-related impact, but the fact that the economy was down significantly. So we are looking at a major scenario where the government had to do something about this kind of contraction, this kind of global impact. So the gambit is well established now. Of course, we had our Atmanirbhar 1.0, 2.0, and 3.0. These are very, very strong words which don't even get into many of people from the south. Atmanirbhar is sometimes pronounced as Atmanirbhar. Not the right word, it is Atmanirbhar. And increase in capital expenditure is definitely seen in the budget across all sectors. Significant emphasis on infrastructure. Because asset monetization is something which you need to really look at carefully, because there is a lot of land, significant land owned by government and public sector undertakings, and railways also holds a lot of land. Already these projects are already in cart, and some projects have already started from railways. So this is an interesting thing from a revenue mobilization strategy. Some kind of balancing act has been done, and as was rightly pointed out to the earlier speaker, the deficit has not been that much of a concern, and the budget has not been structured in a careful manner that we have to please the rating agencies and keep it at a very low deficit. We've gone ahead and decided to take a plunge and see how the economy responds. Next. These numbers are actually startling. If you look at the corporate tax, the budget estimates of 2020-21 was about 6,81,000 crores. And look at how it has crashed. See, as professionals and businesses and corporates which had seen the lockdown and the impact on the revenue and your budgets and strategies, etc. From a government perspective, numbers coming down is huge because they are already operating on a deficit. And you still have to maintain your salaries, you still have to make your payouts and things like that. So it's really been worrying. And despite that massive drop to 4,46,000, we are still going to estimate about 5,47,000 crores in corporate tax, which means the government is very, very bullish the way the economy is going to respond. And the personal income tax, if you look at it, jumped from 6,38,000 to 4,59,000. It is again jumping back to 5,61,000 crores. So the signs are quite clear that it is just not some kind of a general estimate, but the government is confident that business is going to do well, profit is going to do well, consumption is going to take place big time, sales are going to happen, revenues are going to be high, as a result of which taxes are also going to go. On the customs front, it came down and it's gone back to its old level. And the excise and the cess is in the context of the petroleum product related taxation. The service taxes from the SVLR scheme, what was still pending with the executives to get there. CGST, you're looking at 5,30,000 crores. GST, you would have known for the last 4 months has been fantastic. The collections have been fantastic. And you're looking at something like 190,000 crores in January. Of course, a lot of people are talking about the fact that this is only because of the fact that the rules have changed and the fake invoice racket has been arrested and people are paying the taxes more. Just to a certain extent, I don't think that is a big reason for the jump. The jump is because of the fact that business is doing well, consumption is doing well. Next. So this is a favorite game which we always play. In fact, MRV used to joke about how I would talk about the story of the umbrella. In fact, in the earlier one of the MCCA presentation, we have seen how the umbrella had been taxed and not taxed and reduced to tax and then exempt and things like that. Nowadays, in the last few years, the custom duty changes are all well structured and well planned. There is a clear agenda behind all these items. So you're looking at, of course, focusing on domestic manufacture. So to increase domestic manufacture, you try to increase the tax on the raw materials or try to do something else in terms of where you identify as competition, adjust certain duty structures. So some major changes have happened and the duty rates have gone up for these. Next. And in case you've not watched, those of you who are serious about watching the good web series, Money Heist is a very, very interesting thing to watch. It tests your patience to some extent, but it's still a nice one to watch. And for those of you who not understand Tamil, Pon means gold. Therefore, I put this Pon Magal Vandal for this slide where we talk about gold in the budget. This is an interesting phenomenon in this budget, is that you reduce one rate of duty and then you increase under some other name. And you do it in such a manner that people don't really understand what's going on. So the markets get confused, the businesses get confused, the media gets confused, the WhatsApp university gets completely confused, and therefore there's a lot of information, misinformation going on for some time. So in effect, what has happened is that gold rates have actually come down. Duty has come down from 12.5 to 7.5%. There is a levy of cess, agricultural infrastructure development cess of 2.5%. But the biggest advantage is that when you reduce the duty on gold, you have seen every newspaper, almost every alternate day, some fellow or other would have found some methodology to hide a part of the gold in some part of the body which even the doctor does not know. So that is a kind of smuggling that was going on. So the smuggling is high because the duty is high. So you reduce duty, smuggling will come down. It's a simple philosophy as far as customs is concerned. Then there is an interesting amendment in the context of Customs Act. See, normally what happens if there is something which has been seized? I don't know whether this has got something to do with the news item which happened about some gold thing. Maybe it is there. We have to check. Well, there's always an agenda behind amendment. So there's something which is seized. And if it is seized, the proceedings have to be launched, prosecution has to be launched, pre-trial, the goods are to be carefully kept. And therefore, to avoid all these things, there is a mechanism to go to the magistrate, get the whole thing inventorized, and then take a photo of it and keep a certificate of this photograph saying that so-and-so item is held at so-and-so. Then the trial goes on. So now they're desiring to move away from the magistrate and give this power to the Commissioner of Appeals. So the Commissioner of Appeals will now have to takes on this power of inventorizing, taking photographs, and keeping that to ensure that the goods are safely kept and then brought it when the prosecution when the trial takes place. Now, 2 points here. One, why would they have to take it away from a magistrate? Nobody knows why they do. Why should a Commissioner of Appeals do this activity? A Commissioner of Appeals is after all an appellate authority. He is supposed to have he's a quasi-judicial authority in charge of appeals. They probably discovered that the customs appeal litigation is quite low and we can probably give some work to the authority concerned. That could probably be a reason. But I'm not too happy with an appeal authority doing this kind of a work because at some point he may have to decide whether the confiscation is legal or not. So that will be a conflict of interest. So we want to encourage we are seeing massive steel consumption happening. Construction is going to go big. Highways are going to expand, and we're going to see serious steel consumption. Steel prices are at an unbelievable high. Some kind of change is happening whereby scraps are going to become completely exempted. Copper scrap is reduced to 2.5%. Certain raw materials for steel is also exempted. So, and interestingly, temporary revocation of anti-dumping duty and countervailing duty on import of excess flat products from China and Indonesia. Because there were sarcastic comments in social media saying that on one hand, you're unhappy with China and you want to dislodge all the apps that come from China. And on the other hand, you're okay with the SS flat products coming from China and Indonesia. In case you watched Mirzapur, the season 1 and season 2, you will notice that the biggest element of that is that somebody or other will be knocked off on a regular basis. So it's some person in the family would be disappearing over a period of time. Of course, not due to natural death. So here, in the context of customs, the number of exemptions have been withdrawn by omitting a few entries. Now here you have to be very careful. Some exemptions have been withdrawn from 2nd February 2021. Other exemptions are being withdrawn from 1st April 2021, and some more exemptions will be withdrawn from 1st October 2021. So you keep track of In case you're claiming exemptions, you must watch the space, keep very alert, be very alert, and notice in case some change is happening. One more interesting development is that they're now saying that if it's a conditional exemption, that means if the exemption is subject to certain conditions, the notification will be valid for a period of 2 years. So you can rest assured that it will not be tinkered for at least 2 years. After 2 years, they will review it and see whether it is worthwhile to exempt or not. Now, there's a plus and a minus. The plus is that you get clarity. So, especially for long-term projects, especially where you're quoting on a tender, where certain imports are involved, you're very clear as to what is going to be your cost. That will be the plus. The minus is that assuming the exemption is critical, you will have to be alert and inform the government much in advance to ensure that the exemption is restored. And in case for some reason the exemption is not restored, you could have unnecessary temporary headaches. Next. So this is the new cess, Agricultural Infrastructure Development cess on duty of customs from 2nd February 2021. I read some of the news reports where the former finance minister, Mr. Chidambaram, was very upset with the fact that cess is a backdoor mechanism for collecting taxes and keeping with the center and not sharing with the state. It's, memory is very interesting. Our former FM was the one who brought this education cess in 2004. Primary education cess, and then it was called a secondary education cess in 2007. And we had multiple cess. We had different kinds of. We even had a research and development cess levied by the RBI for import of designs and drawings. So we had enough cess. So cess is something which the government regularly uses. Of course, this time it is more relevant because the topics are very significant from revenue sharing, and states are also reeling from a GST compensation issue, and therefore it becomes a much more significant point. AIDC need not be shared with the states, and therefore the 41% revenue share which will devolve to the Finance Commission formula will not, this amount will not come. And the press conference of Mr. Pandey indicated that 30,000 crores is expected from this agricultural infrastructure. Let's see what are the items that are covered. I'm using MasterChef for this because almost all the items are food items. So, interestingly, I don't know what gadget our FM used, assuming it is an apple. The apple that is used by her is not what is being taxed here. The apple, crude palm oil, crude soybean oil, crude sunflower seed oil, peas, kabuli chana, Bengal gram, chickpeas, lentils. These are all items that are taxed at a huge AIDC of 40%, 50%, etc. And then the best one is reserved for the last. So you want a nice wine along with your food, then your wine is going to be costlier. The foreign wine is now attracting another 100%. All the whiskies and all other hard drinks are also attracting 100% AIDC. This is a significant amount of collection. So this is what I meant: poor communication, poor packaging. Everybody in the media, especially some of the regional TV channels, were jumping and saying that petroleum prices are going up, diesel prices are being increased, duty has been imposed on these. Some sensitivity is also required from the government when there is so much of talk about petrol prices and diesel prices. You should be very clear that the prices are not going up. In fact, prices are not going up because what has happened is that you have put this agricultural infrastructure development cess. At the same time, you have removed the other duties which are equal to that. So the BED and the SAD of these items have been reduced. So consumer does not bear any burden. So you actually neutralized it. The effect of putting this is that the pockets of the center might be a little more enriched compared to the normal collection. The price is not changing. So again, communication is very critical. Because of poor communication, all kinds of memes are going around in terms of petroleum prices. Next. I call this Pavak Kadaigal. Why? I don't have to explain this. Every person who's engaged themselves with the GSTN portal would have faced at least one technical glitch at least once. If that is a kind of technical, and if you are filing through ROC, all the more MCA portal and GSTN experience has been not the best of experiences. And now what do we have? We are now going to the customs portal. So the customs portal is going to become fully electronic. They're going to notify a portal. Everything and all customs, registration, bill of entry, shipping bill, other documents, everything will go to this. And even the notice serving will also happen to this. They somehow seem to think that these are all working seamlessly and beautifully. But the harsh reality is that most of the professionals work in midnight and early morning to ensure that the data is uploaded. So this is not something which is a good sign, good thing to do even for professionals. This is a very welcome amendment. See, many of you know that somebody will come for an audit. somebody will issue a summons. Somebody will ask for some data. And then at some point of time, nothing happens. Then 2 years later, another officer comes and asks for the same data, same kind of summons, same kind of information. Another 2 years, nothing happens. Then 3 years later, somebody comes and asks for some more information. So this is the kind of information that is continuously asked. So finally, they're saying, you're doing a summon, you're doing an inquiry, you're doing an audit. You either culminate into convert the whole thing into a show cause notice in the next 2 years. If you don't do that, there ends. If a show cause notice is the end result of all this does not culminate in a show cause notice by 2 years, matter ends there. Nothing can be issued. Of course, 1 year extension is available as far as Commission is concerned. And of course, knowing the bureaucracy, they said, sir, what will happen to all the past things before this amendment? There could be a lot of things which are pending. Don't worry, we'll protect all of them. None of this amendment is applicable to proceedings initiated before this date. So for the old initiation, you will have to wait forever till it gets converted to something else. This is an unbelievable amendment. This is going to have an impact. The current bill of entry can be filed before the end of the next day, following the day, excluding holidays. Now they feel that the logistics people are very, very hardworking people, and they don't care about holidays and things like that. They always like to work. They're very hardworking people. They said including holidays. The interesting thing is that when you look at the notes on clauses as to how it is being amended, Section 46(3) is being amended so as to mandate filing of bill of entry before the end of the day, preceding the day of arrival. So they're trying to ensure that they are going to put some timelines to mandate filing of bill of entry even before the end of the day, preceding the day of arrival. So it's going to be very, very tight. This is probably for some kind of rating abroad in terms of facilitation and trade ease and things like that. But it's already a nightmare in terms of from a customs board. Next. This is something which out of syllabus. In GST, there is this big fake invoice racket. At least the government believes it to be very big, and therefore they take all kinds of action against that. They've taken enough action, and now they come to this conclusion that somebody could use a fake invoice, and based on the fake invoice, they could export, and based on the export, they may get a refund or a remission of duty or tax, and therefore they are now amending the customs law to say that if such an exporter gets any benefit through an invoice, etc., you pay a penalty under the Customs Act, not exceeding 5 times the refund given. Now, I'm baffled by this amendment. You are not claiming a refund under the customs law. You are claiming a IGST refund, which is a levy under the GST law, and you have enough penalty for all those fake invoices. How can you impose a penalty under the Customs Act when the relief is flowing from some other legislation? So this is mind-boggling in terms of how they think that they can actually put a penalty under the Customs Act. Customs Act cannot apply to a transaction when there is no benefit obtained under the Customs Act. Oh, in case you have not seen that Bad Boy Billionaires, that's also an interesting documentary to watch. So we move on to GST. I still recall some of the earlier slides. We tried to put a blockbuster, whether you like the movie or not, it was definitely perceived as a blockbuster. So we call GST always as a blockbuster. You are aware of the decision of the Supreme Court in Vodafone case, and you are also aware of the amendment made retrospectively. Of course, one of the votaries for such an amendment is very much in this panel. I will not mention names. So the Vodafone decision was nullified for a retrospective amendment, and the retrospective amendment is obviously questioned, and matters went into arbitration, and India lost the arbitration. Clean Energy again, India lost the arbitration, but the government is still keen to fight that. It's amazing as to why they want to pursue this. They should have simply accepted the award and said that we will not do any more retrospective amendments. We leave it as it is. But we felt that the revenue was so good. Sometimes you look at these numbers, forgetting growth, forgetting investments. Now, this has an impact on investments, but the story is not over. They look at all other decisions can be nullified. So we had the Supreme Court in the case of Calcutta Club, which said that mutuality is applicable. If mutuality applies, service tax cannot be imposed, VAT cannot be imposed. So this was a brilliant decision, and it analyzed every aspect of the doctrine of mutuality. Now, some of us applied this judgment and said that the same judgment would apply with equal force to these concerns. Because GST also, it requires a supply between two parties. And some went to AAR and asked the question. See, normally, you are aware that if you go to AAR and ask a question, it is always held against you. But there are rare events when the AAR rules in favor of the SSC. This was those rare events when they said that Rotary clubs are not taxable because mutuality is applicable. Now, when such a rare AAR circular comes in favor of the SSC, the government decides to nullify the AAR ruling also. So we have an amendment to say that the mutuality would not apply, and that too from retrospective effect from 1/7/2017. Of course, as a lawyer, I can tell you that the amendment is not the end-all story. The consideration aspect is still not addressed. The defects pointed out by the Supreme Court is not addressed. Therefore, there's a 2.0 round litigation still possible as far as clubs and associations. As far as input tax is concerned, you're aware that 4 conditions have to be satisfied. Already the condition of the fact that the supplier should pay the tax is under challenge. And all of you would have faced horrendous times with the department asking for details of your GSTR 2A, compare it to GSTR 3B, GSTR 2A versus what has been shown, all kinds of questions, 5%, 10%, etc. Now you have one amendment which says that your condition for credit is now 2AA is added to say that unless your supplier uploads the GSTR 1 and the details are reflected in your GSTR 2A, you cannot get input tax credit. All right? What are we talking about? The section itself is coming only now. The section itself which says that you should match the GSTR 2A and GSTR 3B, or the supplier should upload the GSTR 1, is walking into the statute books only now, that too through a bill amendment. And this has to become an act, this provision has to be notified. The entire country has to, all the states have to pass the legislation. But despite, if that is the case, next slide please, the entire exercise done till date becomes illegal. So if 16(2A) is a condition for availing ITC and will come into force only from a date notified, the entire exercise of examining GSTR 2A for ITC eligibility for the past period becomes an illegal exercise. And even this amendment, you can apply the doctrine of impossibility because this will be tested. How can I ask my supplier to upload GSTR 1? How can I force a supplier to upload GSTR 1 and insist that only then I can get the credit? My good friend here, some of the good friends here are chartered accountants. They are all fuming. The social media is abuzz with fire with some of the amendments that have happened. What has happened in GST is that 35(5) is knocked out, which means professional audit by an audit by a professional in the form of GSTR 2C, GSTR 9C, which is reconciliation of your financial statements and your tax returns, is no longer required. Of course, 35(5) will get omitted only from the date to be notified after the act comes into force. So 1920 will definitely still invite GSTR 9C. Now, what is annoying is that the minutes of the GST Council of 39 GST, the 39 GST Council discusses with some elaboration. They discussed this in a very, very peculiar manner by saying that the tax recovered on account of GSTR 9C is X, whereas the professional fees paid to the professionals is 5X, and therefore there is no necessity for an audit. This is atrocious. Who's the government to decide what is the time involved? And none of these audits are simpler audits. If you look at the GSTR 9C and the kind of requirement that is involved, it involves tremendous amount of professional work. So you cannot undermine professional capability and professional work by saying that I'm not even an auditor. I'm supporting this profession for the simple ground that you cannot justify an amendment by saying that somebody is charging too much. That is not your point. Required from your legal perspective to look at audit of the books, yes. If not, you take a stand. So now what is happening is that they are removing this, and instead the reconciliation has to be done by the assessee himself. Of course, I'm calling it blacklist because of the fact that there was also some of the chartered accounts who went on a protest. They were protest against the GST law itself. So there were a lot of noise about chartered accounts not being happy about this entire exercise, and a lot of signing campaigns were going on for extension of time. Maybe somebody would agree. Who knows? This is something which has been going on for a long time. 51 of the GST, which provides that if there is a belated filing of return, interest is applicable. Simple. Let us say GST liability is 1,000 rupees and you have input tax rate of 600 rupees. Then you use your 600 ITC and pay cash of 400. Now, in case your return is belated, the government wanted interest on entire 1,000. So I argued saying that you can collect interest on 400 because there is a cash flow that has been delayed. But the 600 you have already collected from the supplier, and therefore you have already enriched that money. You do not ask for interest again. But the revenue did not agree, and we had to fight in courts. The first round of litigation was REFIX, where they said that you cannot put interest on the ITC. But then what happened was they amended the law to reflect that they're not going to collect on ITC, but they notified the amendment from 1st of September 2020. I argued this Manasarovar matter where we argued that the amendment should be perceived as retrospective, and the court held that it is retrospective based on the various council minutes. And now again, they're substituting the proviso to show that it's really retrospective. And as far as those of the young lawyers who are here or young wannabe lawyers who are here who watch Suits, whatever happens in Suits does not happen in profession. Therefore, if you want to become a lawyer or join a lawyer's office thinking it will be like Suits, think again. Now coming to section 75, you report one amount in GSTR 3B and you report a higher figure in GSTR 1. Now GSTR 3B is the one that calculates the tax and you pay the tax, you upload the return based on that. GSTR 1 is supposed to be summary. Now, in case your 1 data is more than 3B data, what section 75 says is that no notice, nothing. That excess amount which you show will be payable, and therefore they will take recovery action to take out that money without any notice under 73, etc. Next. This is unfortunate set of amendments. Notice can be issued to a transporter for penalty, even though the tax proceedings against the assessee have abated. So let us say there is a tax proceeding against the assessee and that has been dropped or action has been taken and has been confirmed, etc. The penalty and the transporter would continue through a separate proceedings. So even though the main issue is concluded, insisting on a penalty is completely not warranted. Next. I'll skip this. We're running out of time. Next. This is an important amendment which is to be taken into account by businesses, manufacturers who move goods as well as all transporters. I'm amazed by the language in 129 and 130 right from inception. They give you two situations. If you are caught in a roving check post and the officer comes to a conclusion that there is a violation, you have two choices. You either come forward and pay the tax penalty, or you say, I will not come forward and pay the tax. Now, what happens is when you come forward to pay the tax and penalty, currently you have to pay the tax and penalty equal to 100%. If you say, no, I don't agree, I don't want to come forward and pay the tax, you still pay them. So it is not, there is a third scenario that there is no defect is never contemplated. They assume that there is a defect. Now what they're trying to do, they're amending the whole thing by saying that the owner comes forward for payment of penalty is equal to 200% of the tax paid. No longer tax, but only penalty of 200%. And if the owner does not come forward for payment of penalty equal to 50% of the value of goods or 200% of tax, whichever is higher. Look at the kind of amounts that we're talking about. And we are assuming that the officer is going to be absolutely clinically precise and clean and not adopt any kind of unethical practices to stop your consent. Next. Earlier, at least you could release the goods by giving a bank guarantee. Now they don't like that also. No, you don't want security, you pay. And now what are they talking about timelines? Notice within 7 days, order within 15 days. If you don't pay by the time, order immediately. If you don't pay within 15 days from the order, they can sell the goods, they can sell the vehicle also. Next. So since the now penalty is a separate proceeding and you go on appeal against a penalty order, you have to deposit 25% of the penalty to go on appeal. And if you lose the case for the first appeal, then you are in trouble because there is no GST tribunal. It's amazing that after 4 years, we are still yet to see any kind of change to create a GST appellate tribunal, despite the fact the country is full of litigation in terms of GST, where orders have been passed by the first appellate authority. Now they want to collect data. Earlier, they only collected statistics. So any commissioner or officer authorized can direct any person to furnish information. Fine, let them collect the data. But what is interesting is that they have omitted one particular section. That is section 152, subsection 2. That said that only people who are concerned with collection of statistics under the Act and people who are looking at prosecution under the Act can look at this data. By omitting this data, it looks as if data can be shared to anybody. Now, I don't know how much this is going to be tested in terms of privacy law and privacy principles, but it looks like a very, very shaky amendment. This is my last slide for the day. This is as far as the exports is concerned. On one side, the government wants to encourage exports, and our previous speaker talked about the fact that 5 years we had 0% growth in exports. Government wants India to become a textile hub. We want textile parks to be created. You want maximum exports to happen, and all those things. And then you mess up the law. So currently, what happens? You have two options. One, you export, and you pay the IGST on the export and take back refund. Alternatively, you export by giving a letter of undertaking or a bond, and you don't pay any IGST on the export and claim refund of the input tax credit. Now, as far as goods are concerned, you simply have to export. Now they're saying, not only should you export, you bring in the foreign exchange. Okay, they have this because they brought this to the rule. The rule did not come through the section, therefore they're fine. But the other worst thing is that the option of payment of IGST on export and taking back as refund is removed. That means only one option. Export under LUT or bond, take refund of ITC. Paying IGST on exports will be given only to a privileged few. So government may specify class of persons who may make zero-rated supply on payment of IGST and claim refund of that IGST. Or government may specify the type of goods on which you can do that. Otherwise, it is not open to all. So which means what? The ability to encash your ITC, because what happens in the IGST payment on exports is that it works faster. You file your shipping bill, the customs comes into the picture, you get your money out quickly. But if you go for refund of input tax credit, it takes a longer time and sometimes it doesn't come. So again, probably cash flow pressures or whatever it is. But then what happens is that you become less competitive. If you're not going to get back your refund of ITC and you're going to accumulate your cost by accumulate ITC, it's a useless asset. You can't monetize that ITC also. So even if you have 350 crores as input tax credit, no bank is going to give you a loan. So unless you're able to monetize that ITC, it doesn't serve any purpose. So 350 crores will sit there and it is a cash outflow, and therefore your price will also have to go up and your export is going to be less and less competitive. This is a completely retrograde amendment. This is completely not warranted at this point of time. Only one thing is that this bill has to come into force. Of course, being an IGST Act, you may notify it very quickly. So in case the chamber has to make a representation on this point, this is the first point they should present before the bill becomes an act, because it's a very important amendment which needs to be passed. So with that, I would conclude, and thank you once again for very patient hearing. Looking forward to other speakers.
Hello, ma'am, can you hear me? So can you hear me?
Yes.
Yeah. Okay. I think I was not audible earlier. I invited Mr. Vaidhi saying Vadi coming, and he lived up to the name master with his excellent presentation in his inimitable style. I've watched most of the serials and movies, and there can be no better comparison, sir. Thank you. Now for the next speakers, Mr. Aravind Srivatsan. He's a tax leader and leads the tax practice of Nangia Anderson India Private Limited. He's also the lead partner for international tax in India with Anderson Global Network. He has more than 20 years of experience, and his area of specialization include international tax, corporate income tax and fiscal regulations, India inbound entry advisory, financial services tax and regulation, focus on NBFC and fintech, tax policy advocacy including alternate dispute resolution, promoter and family business solutions and deals assistance, valuation and diligence. He currently chairs the Direct Tax Committee of the Madras Chamber and is a member of the Bombay Chartered Accountant Society Tax Technology Committee. He's a bachelor's in commerce and accounting and also done FCA, CS and CMA. I will also introduce Mr. Vikram, who will be sharing the platform with him. Mr. Vikram Vijayaraghavan is an advocate at Subbaraya Iyer Padmanabhan Ramamani Tax Advocates, one of the oldest tax law firms in South India. He litigates regularly before various judicial forums, including tribunals, high courts and Supreme Court, and consults for a number of corporates across South India on tax issues. Before pursuing law, Mr. Vikram had an engineering background with 2 masters in computer science and electrical engineering from Stanford University, California, USA, and has worked in successful startups and currently owns a software consulting company, Vulcan Tech Software. With his dual background, Mr. Vikram has, among other things, developed a number of free mobile apps of various acts, which are currently being used by thousands across India. Mr. Vikram serves as the co-chair of the MCCA Direct Tax Committee and has spoken on invitation at a number of conferences. He also serves on the board of a number of companies in South India and is the organizer of the popular K.R. Ramamani National Tax Moot, conducted by the School of Excellence in Law, Tamil Nadu, Dr. Ambedkar Law University. Don't be bowled over by Mr. Vikram's qualification. He has another side. He is a budding Mridangam artist, finding time to learn and practice in his busy schedule. And one more information before I pass on to Mr. Aravind. Mr. Arvind's address on Budget 2021 in YouTube for 5.5 minutes gives you in a nutshell the entire budget speech of the Finance Minister with his comments. With his permission, I would share the link in chat after his address here. Thank you. Over to you, Mr. Aravind and Mr. Vikram.
Yeah, good morning, everyone. I want to start by saying we still have a big clarification on the direct tax proposal. Thank you, Vaidhi, for making it, putting it in the right perspective. And I know that we are behind time. We have 40 minutes. We have 2 more sessions. I'm going to straight away request Vikram run the slides.
Yeah, absolutely. Thanks a lot. Can I request the Madras Chamber to allow screen share rights? I'd like to. Yeah. Can you see my screen? Can you see my screen?
Not yet, Vikram.
Not yet, not yet.
Okay.
Yeah, I think it's coming now.
Perfect. Okay, thank you very much. It's always a pleasure to address the Madras Chamber, and it's a privilege to be in August gathering with so many senior tax and expert professionals here. And so what I'll do is I'll present the direct tax amendments so you can ask them the questions. I am very happy to share the Direct Tax Committee chairmanship with Mr. Arvind and also be guided by Mr. Sriram Seshadri, and also have the privilege of being a colleague of Mr. Vaidiswaran. Let me dive into the details here. What I have done is in this analysis PowerPoint, which I'd be happy to share, I've covered every single clause that is there in the memorandum, every single clause without fail. Obviously, due to time constraints, I would like to focus only on certain important amendments which have been there. In fact, there are quite a few amendments which are deeply impactful in direct taxes. So what I will do is there are around 70 amendments or so, all of which have been covered in this slide, which I'll share, but I'll concentrate on like these 18 amendments, which I feel are the meat of the direct tax changes. Now, before I'm starting, I would like to say that the devil is in the details, and I'd like to spend details making it a purely technical session. And being an advocate, I'll play devil's advocate because I'm not happy with quite a few of these amendments. Now, let's start with what I would say is the biggest change which is there, which is the new reopening regime. See, what happens is, many of you know that reassessment or reopening or income escaping assessment, as it is called, Section 147, is kind of the holy grail of tax litigation. What typically happens is there is a 6-year period from the end of the assessment year wherein the department can come back and reopen your assessment. Typically, if there is a scrutiny assessment, obviously it is 4 years, and also there is a further bar on the department to prove that the assessee has fully not disclosed material facts. Now, the whole reopening served as a very important bulwark of saving the assessee from the department coming and in the future essentially reopening various issues and keeping on litigating on that. And how it was saved was the notion of reason to believe. I'm sure I'm preaching to the choir here, but most of you know that this important phrase, reason to believe, in Section 147 essentially said the assessing officer can't, by basis of a change of opinion, do a reopening. And so this was a very good safeguard. There has been tremendous jurisprudence, and starting from Kelvinator, going to Forum France, there are any number, there are literally thousands of decisions, starting from the last amendment in 1989 to various small amendments which have been made in Section 147. In a sense, Section 147 is kind of the most litigated with respect to assessment procedures. And what is really surprising is when the finance minister made the speech, it was going to be from 6 years, it will be 3 years, and everybody was very happy and rejoicing. And when you look into the details, as they say, the devil is in the details, it was a real shock to see what has happened. What they have really done is essentially throw away the old reopening scheme and come up with their new method. And the memorandum gives an idea of what is happening. It says information is received from other law enforcement agencies. I'll read the highlighted portion. Therefore, assessment or reassessment is information driven. The need to completely reform the system of assessment or reassessment would result in less litigation. I really don't think that is the case, and I'll explain why. What now happens is there is going to be an assessment or reassessment when there is information available. The notion of reason to believe doesn't seem to be there in the section itself. It no longer seems to be codified in the new section itself. Entirely 147 has been replaced with new language. And it says information. And what is that information? Any information which has been flagged in the case of the assessee for the relevant assessment year in accordance with the risk management strategy formulated by the board shall be considered as information. This seems to me a peculiar and wide-ranging assault on the system of reassessment which was there earlier. And it also says specifically, interestingly, to all those who have been doing cases and have been involved in cases, audit objections can't be the cause for reopening. There are any number of judgments, including Supreme Court judgments. There is a specific amendment here which says a final objection raised by the CAG, it shall be considered as information. Further, the search assessments have also been folded into 147. There is no separate search assessment, 153A, BC, etc. Everything has been folded into this umbrella of information. And in case of search, it is deemed that the assessing officer has information which suggests the income has been chargeable to escaped assessment. Now, the one good news is the GK and drive shaft procedure, wherein there will be a notice to be served, and then the assessee will reply, and then the speaking order has to be passed, has found a codification in this new law. But the fact of the matter is there are various other small tweaks which go against decisions which are there. For example, many people would know in the current reassessment scheme, if the assessing officer reopens or reassesses and finds new material or new issues, he usually has to issue notices for each of them. Now, this is called explanation 3 in the current scheme, and that has been done away with by saying that even under this procedure, notwithstanding the procedure prescribed in 148 was not followed, such notice can be issued for reassessment. So all in all, one of the interesting points is it is a complete revamp. It is not like how it came across as a 6-year to 3-year, but it's a complete revamp. The another important point is, what about the time limits? The finance minister mentioned 3 years and 10 years in her speech, but the devil is again in the details. It says no notice shall be issued if 3 years have elapsed from the end of the relevant assessment year, and it can be taken only in a few specific cases. Now, what are these few specific cases? In specific cases where the AO has evidence which will reveal income escaping assessment represented in the form of an asset amounts to or is likely to amount to more than 50 lakh rupees. It seems to be a very small amount that can be up to a period of 10 years. So my assessment is, in fact, there will be a lot of reassessments which are essentially 10 years, because the 3-year limit to the 10-year limit seems to be an easy bar to cross. Now, the points to ponder here are many, but I would say the biggest takeaway for me is this. You see, there's a very famous statement which says, different is not always better, but the better is always different. Just to be different, they have thrown away the old jurisprudence, the bulwark of jurisprudence of thousands and lakhs of cases which were there, and come up with a completely new scheme which works on information, and that information is going to be vaguely defined, and it will be a rolling stone. I'm very happy with this, and I'm quite sure most of the professionals and auditors will agree with me on the same. Now, what has happened is it's based on risk management strategy from third parties, from search, from audit objections, and really it is going to be a 10-year reopening rather than a 3-year reopening. So all in all, this according to me is the biggest change in this budget, that there's going to be a completely new reopening scheme. Now, let me move on because I have paucity of time. I'd love to discuss various case laws, etc. I don't have the time in this session.
Vikram, if I could just mention.
Absolutely. Please do so.
Yeah, so Vikram, very well summarized. What kind of comes to me as very starking aspect is, on one hand, to drop the timelines for issue of notice to completion of assessment. The whole process of getting your refund, getting your assessment done will happen in 13 months. But then you have a provision which actually goes back, and after you implemented faceless, where you have so much of faith, you have a provision which actually says no. I mean, it can go up to, after having faceless, you still have a situation where you can have uncertainty of tax positions going into significant point in time. And again, it kind of makes me understand, having dropped the tax rates down to 25%, 22%, 15%, is there a method that really wants to send a very strong message coming out of, not just reassessment, but whole, there are other provisions as well. It's a clear message. Don't mess with me types. One is we are watching you. We know what is happening, and in case then, even if we have a foolproof system, 3 units. So after going through the rigors of this, case will come down. There will be a reduction in the case going on the key. I think it has something slightly reason. The point of risk management strategy, I think it's one of the background. The risk management strategy, as we all know, is also something which is not known. Today, you don't know on what basis you could get a notice for the assessment. So if that is going to be used as information or deemed as information that could be used, these are genuine concerns, and these are concerns also from the investor community who need to provide capital, because the way they do indemnities depend on the period to which the reassessment or change in assessment position Over to you, Vikram.
Thank you. So the next one I'd like to focus on is the advance authority ruling. So a lot of cases are with the AAR, pending application with the AAR, so as to essentially determine the taxability of a transaction. Obviously, it applies only to those transactions. Its persuasive value is there. And we have had various different kinds of rulings in the AAR over a period of time. It's both Bombay and Delhi have AAR benches, and the progress of the AAR has been slow. But surprisingly, what has happened with this government in this finance bill is, let me read the memorandum here. As per past experience, the post of the chairman and vice chairman have remained vacant for a long time due to non-availability of eligible persons, and so on and so forth. And therefore, there is a need to look for alternative method. It seems like they are not able to fill the retired judges' post, and hence they have come up with this whole new scheme of a board for advance ruling. They are scrapping the AAR, coming up with the board for advance ruling. Now, the reasoning seems to be a little peculiar, but what is worse is the board for advance ruling is going to have only department officers. There's not going to be any legal judicial person involved in it, essentially from the common taxpayer or from a lawyer perspective. And what would happen essentially, this is a department committee which is going to be deciding issues on taxation. What is worse is usually from the AAR, you file a writ to the High Court. Now what it's going to be is an appealable to the High Court. So to be practical, what is going to happen is assessees are going to approach the AAR. It's going to consist of department officers. It's not going to be binding on the department apparently. And even if they decide against, lo and behold, they decide against the department will go on appeal to the High Court, and it will be log jammed there for quite a while. So the effectiveness of the AAR has been dealt a body blow, according to me. And if I'm not mistaken, indirect taxes had this notion where advance rulings were from a department officer board, and it was not a pleasant experience there either. So I don't think this is a positive move. This is another retrograde move, according to me. Now, if I may move on to the faceless tribunal, it's one of the other provisions I wanted to focus on. The tribunal has been one of our homes wherein the final as a final fact-finding authority, there has been a lot of cases where the tribunal has stepped in and said that lay down the law, because going to the High Court and litigating in the High Court may take many, many years, in fact, dozens of years in certain cases. So tribunal has been a very effective mechanism overall for solving disputes, and making this faceless seems to be quite a shock to the system, especially with the introduction of a dynamic jurisdiction. Now, the one good thing is this is 2023. By that time, it's going to be notified. But in terms of tax advocacy practice and litigation, this is a major change, and we have to see how this is going to play out. One of the things that was mentioned a little worryingly was, if required, hearing would be given. I don't understand how that if required plays into natural justice principles that the tribunal is really built on. But this is another major change which is there by this budget. And settlement commission, just like this government has basically said different is always it's not always better, according to me, but they've gone ahead and said settlement commission is not something that we really are interested in, and they're discontinuing the settlement commission. In fact, what they're going to do is the pending applications in the settlement commission are going to be going to an interim board. You can of course choose to withdraw from that pending application and go back to the authority where you were originally supposed to go. But the idea is that the settlement commission itself is going to be wound down from 1st February 2021. In a way, even if you remember, recently there is this case, Abhishek Singhvi versus the CBDT, wherein whether VSV can apply for the settlement commission. And now clearly that was also an amendment which was brought by this budget. Clearly they are not interested in having settlement commission as a dispute resolution mechanism anymore. So there ends the matter with settlement commission. Now, one of the things, now let me go on to the more technical aspects. I spent some time on that. Now, the 194Q was introduced, which is a TDS on purchase of goods. All of you would remember the earlier budget introduced 206C1H, which basically was on the seller. It was a TCS provision. Now there is a TDS provision, and there are some thresholds which are there. The total sales has to be exceeding 10 crores in the financial year immediately preceding the financial year. And then it's a TDS is 0.1%, and aggregate of value should be 50 lakhs in the previous year to the seller. Now, it does not apply, of course, to cases where tax is deductible under any other provision. It has a particular exception, which I wanted to point out. If the TCS is required and as well as TDS is required, then the transaction only under TDS shall be carried out. This is a specific amendment which has been made. Also, if there is no PAN supplied, it is 5%, and all these amendments will take place from 1st July 2021. I expect there will be some set of clarifications, but the general move is that purchase of goods also, the government basically is going to get some money very quickly. That's what is going to happen here. The rationale is it's only 0.1%, but every cash flow amount counts. Arvind, you want to say something?
Yes, I think there is a concern. It was there even under 206C. What is the meaning of the term goods, and does it cover software, intangible assets like this? I think that same concern is also imported under 194Q, and there is also a concern it would also cover some specific financial transactions like transactions in unlisted shares. So you know, with the import of this definition of goods, those related provisions and concerns also kind of come in.
Exactly. I think, yeah, the same concerns with 206C, as you pointed out, will start coming here, and we are looking for clarification from the CBDT on this. Now, the next one I'd like to talk about, which is an important one, is the slump sale amendment. What happened essentially is, all of you would remember the slump sale amendment in definition in section 242C basically means a transfer of one or more undertakings as a result of the sale for a lump sum consideration without values being assigned to individual assets. There are a number of important cases on this, Artex manufacturing, etc. Now, the interesting thing here is certain judicial forums had held that a transfer otherwise than a sale, then the provisions of 50B will not apply. And some of the important judgments are Bharat Bijli and Oricon, wherein, for example, they transferred it, business division and against shares, getting shares, and it was considered a slump, not a slump sale, but an exchange. And so 50B would not apply. Now, this was always going to be controversial, and I think that the government quickly came into play here and said, in order to make the intention clear, they amended the definition of slump sale so that all types of transfers as contemplated in 247 will have will flow under slump sale too. And this, one of the important changes with this finance bill is that some of these substantive amendments are actually taking place with effect from assessment year 2021-22. One of these slump sale amendments is such similar, and goodwill is also the same. Right. So this is a technical amendment which was made, fixing overriding certain decisions. As usual, most budgets will override certain judicial decisions, and this budget is nothing new. The next one I would like to focus on is, yes, the transfer of capital asset on dissolution or reconstitution. Well, this has a checkered history. I don't want to belabor too much on it, but a lot of you would remember 45(4). Now, 45(4) basically provides the profits and gains arising from the transfer of capital asset, distribution of capital assets on dissolution of a firm or otherwise shall be chargeable to tax as the income of such firm, and the fair market value of the asset in the date of transfer shall be deemed to be the full value of consideration for the purpose of 48. Now, the key phrase is, of course, dissolution or otherwise. And what had happened is, just to give a background for people, of course, is that 45(3) and 45(4) itself came about because of this whole Kartikeya Sarabhai case, and essentially considering the individual assets and the partnership assets as the same. And there were a lot of tax planning, putting individual assets into a partnership and then essentially dissolving the partnership, reconstituting and dissolving the partnership. So 45(3) and 45(4) really date back to that 1987. But then what happened is there are a number of decisions which basically said, in terms of 45(4), the otherwise does not refer to cases such as reconstitution. In fact, one of the interesting things, and we have argued it as well as many others, in Madras, there are a series of decisions such as Vikas Academy, wherein there was a reorganization of the firm and the reconstitution, and that was said that no capital gains will arise under 45(4). And the other trick that a lot of people use essentially is the self-generated assets such as goodwill would be used to reevaluate the capital account, and then there will be an excess of credit in the capital account, and again this used to be escaping capital gains tax. So what this finance bill basically did was change 45(4) to specifically say dissolution or reconstitution. I have highlighted the word here. So it is now very clear that this otherwise we can't escape with the otherwise here. As well as introduce a 45(4)(a), which basically says that the excess of balance in the capital account in the books of account shall also be subject to capital gains. And it's interesting to note the proviso, which basically says the balance in the books of accounts will be calculated without taking into account any self-generated goodwill or self-generated asset in terms of the revaluation. So I think this has essentially plugged the hole that was brought about by these various judicial decisions, especially by the Madras High Court. And the other one, which is important on a technical aspect, is, I think, goodwill. This, I think, I'm quite sure has been a hot topic of debate. Goodwill depreciation, the difference between the amount paid for the business and the net worth is, of course, treated as goodwill, as you all know. And Smith Securities was a landmark decision which essentially said goodwill was an intangible asset which is entitled to depreciation in light of explanation 3B to section 32(1). Now, this has been pretty controversial. In fact, there are tribunal rulings post Smith saying that goodwill is not a depreciable asset and giving reasons for the same. But the fact of the matter is there has been a lot of favorable rulings since then, and this has been the accepted norm. Now, the budget clearly proposes the goodwill of a business or profession will not be considered a depreciable asset, and there would not be any depreciation on goodwill of a business or profession in any situation. And they have made a number of amendments to the Act to make this effective, which is going to the term goodwill, section 211B, which defines and clearly said that it will be expressly stating not being goodwill of business or profession, going to 32 and making sure that they are saying not being goodwill in business or profession. Interestingly, section 50, it is amended to provide that in a case where goodwill formed part of a block of asset for the assessment year beginning 1st April 2020, depreciation has been obtained by the assessee. The WDV and the short-term capital gains shall be determined in the manner prescribed. And this is a little controversial, so it will impact ongoing transactions. And 55(2)(a) has also been modified to specifically address this. All these amendments, just like the lump sale amendments, are going to take effect from 1st April 2021 and apply for 2021 assessment year and subsequently. So this is an impact which is on ongoing M&As. And Arvind, you want to talk about that?
Yes. So I think clearly, again, you thought a matter was dead and buried, that you could rely on the existing jurisprudence. Here again, have a situation like in the case of 45A, where effectively after 10 years of a Supreme Court ruling, and you have a certain stated position being taken out of the statute. The concerns also are there are many companies, life sciences, pharmaceutical companies that have huge goodwill on their books. Now, what happens? Clearly, the way in which valuations have to be done, always done, keeping the tax game in the loop. So, furthermore, it becomes important because otherwise it becomes a net cost. So, if you're concerned with this amendment, what would happen to the paid for working, which are already there? There's a concern on appeals where goodwill is being disputed.
Okay, so just to recap, initially we saw a number of administrative changes, the reassessment procedure as well as the AAR and ITAT and so on. Then we have gone on to technical issues such as slump sale amendment, transfer of capital asset and goodwill not depreciable. The other interesting change is again a technical issue which has been decided by courts in favor of the assessees and now being addressed by this budget. So in the case of charitable trusts, the memorandum talks about corpus donations are exempt, and at the same time, the application as part, they are claimed as application, and they are worried about instances which have come to their notice of these cases. It also said that entities taking loans or borrowings and making applications for charitable or religious purposes out of these proceeds. And then when again it is repaid, it's again claimed as an application. So essentially they are saying these are double deduction cases. And also end result is there may be a paper loss wherein the expenditure exceeds the income and it's being carried forward by the assessees in case of charitable institutions. Now, to attack all of this in one go, they have made a number of amendments. They have essentially made 3 amendments. 11(1)(d), basically voluntary contributions which are made with a specific direction that it shall form part of a corpus shall be invested or deposited in one or more 11(5) prescribed modes. So essentially, we always know that the corpus donations which are being made for a particular purpose or specific direction, right? These will now have to be invested or put in 11(5) prescribed mode. Now, the application out of a corpus will not be considered as application of income for a charitable or religious purposes for the purpose of 1023C and 11AB. Now, the other thing they have done is similarly application from loans and borrowings shall not be considered as application for charitable or religious purposes. They have introduced explanation 4 below section 11.1 for the purpose of this. Now, the other thing that they have done is the third limb they've attacked is essentially the computation of income required to be applied or accumulated. No set off of deduction or allowance of any excess application for any of the years preceding the previous year shall be allowed. Now, this amendment is effect from 2022-23, and essentially to again highlight, this has overruled some of the decisions which were there, such as gem jewelry, wherein it was held that in case of a charitable trust, the excess of expenditure of income will be allowed to be carried forward and set off against income of subsequent years. Now, the voluntary contributions which are made for a specific direction and will be forming part of a corpus has been an age-old tradition that you take many institutions which will have. Now that they have to be essentially separately kept under 11.5 and their application will not be allowed is a new change from this finance bill. And we have to see how this pans out. The next one is an obvious one, which is removing difficulties faced by the taxpayer. 234C has exclusions for capital gains in 224(9) because you cannot essentially accurately determine the advance tax liability because of the nature of the income. Obviously, dividend income is the same. We cannot predict the dividend income, and so 234C shortfalls would not make sense. This was actually suggested by the chamber, pointed out by the chamber too, and we see this removal of difficulty being appreciated in this finance bill. The other interesting amendment that we wanted to highlight was the payment by employer of the employee contribution. Now, a lot of you know there are a number of cases such as Delhi High Court as well as Madras High Court, which basically says the late deposit of employee contributions, but even by the employer, is fine as long as it's before the due date of the income tax return. And they essentially said 43B and read the alum extrusions and held it to be retrospective and curative. And so this whole set of cases which were there effectively said both employer and employee contributions, as long as they were before the income tax return dates, that is fine and allowable. Now, the interesting thing here is not everybody expected that there would be some change here, and an amendment has been made to say the purpose of determining the due date 43B will not apply to 3615A, which refers to the employee contribution which the employer pays to the deposits to the PF. Now, the interesting thing here is not all that. These are obvious changes. But the interesting thing is it says, the amendment says deemed to never have been applied for the purpose of. And explanation 5 was introduced has been introduced in 43B, which says the section deemed to never have been applied to a sum received by IC from any of his employees. So this seems to be having a retrospective language. And it seems we have to see how this is going to play out, because this never to have applied is against the principles of this government, which said that they will not do retrospective. Also, curative provisions only should be retrospective and not these kind of provisions. We have to see, and it will be probably litigated on. Let me move on. I don't know how much time I have. I think let's wrap up in 5 minutes. So the TDS and TCS on non-filers are at higher rates. It's an interesting provision in 206AB and 206AC. And essentially the TDS and TCS, similar to 206A and 206CC, which are talking about no PAN, there is also non-filers who seem to have some threshold of TDS or TCS. And these amendments are from 1st July 2021. There has been some clarification with respect to the equalization levy, and I don't have the time for that, but basic idea here in the equalization levy is that this was a tax on digital transactions, essentially by non-residents provided to Indians, and it was quite significantly expanded in Finance Act 2020. The ridiculous part of it was not there in the Finance Bill 2020, but found itself in the Finance Act 2020, surprisingly, and it expanded itself to quite a bit by saying that IP address will be used to figure out how this transaction is. But the biggest problem was whether intra-group services. So suppose the headquarters is supplying IT support or supplying equipment, etc., via an online portal. So an an American headquartered company and an Indian company goes ahead and uses that online portal, whether these intra-group services would be also coming under equalization levy. Unfortunately, there were a lot of clarifications asked for, but unfortunately, the amendment is going the other way. The amendment actually makes it much more wider. In fact, it says the online sale of goods and online sale provision of services, acceptance of offer for sale, placing the purchase order, accepting a purchase order, payment of consideration, supply of goods, partly or wholly. And so this essentially defines it in such wide terms that almost everything will now come into play. And it also says the e-commerce operator, irrespective of whether he owns the goods or not, and the provision of services, irrespective of whether it's provided or facilitated by the e-commerce operator. So these are opening up a Pandora's box of litigation as well as interpretation issues with respect to equalization. It has not made the issue better, it has made the issue worse, unfortunately. So, Arvind, do you want to say anything about equalization levy?
Yeah, no, I just want to say that clearly, I think in the current times, we are seeing coming in through, we are seeing rather transactions being generated through YouTube-led content, and that's where they also seem to have mechanisms where a transaction which otherwise not involved, not directly, are also being brought in by these direct provisions, where an online payment could also trigger an equalization levy. I think while there is a trade deal with the US which is currently being negotiated, which is stuck, there have been some retaliatory measures that have been proposed. I think this is a very bold move. So while it affects a certain class of SSC, it also shows assertiveness of the government to say that if you are earning income in India, while they actually be making losses, he would have to tax you pending the negotiations by the OECD, penalty to these provisions.
Yes, the other couple of things I'd like to wrap up with are one of the things which have been talked about quite a bit in the press is that employee contribution beyond a particular threshold, the interest on it is going to be taxable, and that is exceeding 2.5 lakhs in a previous year in a fund is going to be taxable. Now, with this would hit high-income salaried people, and but the finance minister came out and said it's just 1% of the total subscribers. But I do think that in 2016 budget, the interest accrued on 60% EPF tax proposal was originally there, and then it was dropped after hue and cry. I don't think the hue and cry are going to be affecting it this much, because it's going to affect a higher income threshold, and it will not affect people who are contributing up to 20,833 a month to PF. But the new wage code is going to have a higher rejig, salary rejig of basic salary, and so it will lead to a higher PF contribution. But the fact of the matter is, this amendment, I think, is likely to sail through. The other interesting thing I wanted to cover is that their circle rate increases with respect to real estate home sellers, so 43 CA, right, and also to home buyers with respect to 56,210. The circle rate increase is pretty significant. With respect, 20% deviation can be there. So the guideline value and the consideration value will be a 20% deviation, and that will also be applied. And this applies only to 43 CA and 56,210, the receiver and the seller of real estate units, of home units. And so this is essentially to kickstart the inventory which is there for real estate and try to kickstart that industry. So this is a welcome move overall. And I would try to, last two are the reduction of time limit for assessment. It's pretty surprising. So they're saying that the time limit for completing an assessment is proposed to be 9 months from the end of the assessment year in which the income was first accessible. So we are going to see quicker and quicker computer process assessments, and we'll see where this goes. It's all going to be faceless and hopefully not spineless. The other final thing I'd stop with is that there's this thing of senior citizens who's age 75 who has pension income and no other income, and he can also have actually interest income from the same bank, and they don't need to file a return. I think we are moving to a regime where more and more details are going to be pre-filled, and we are also going to be just faceless robots and just clicking on the submission for the income tax return. Overall, my take from the budget is that this tries to introduce new regimes, especially the reopening regime is a little worrisome. This whole idea that new is better, different is all better is not a great idea. But on the whole, I think that's where we are moving to, the entire digital faceless assessments. And so we are going to see a lot of changes on the procedural aspects as we go further and further, and we have to see how that goes. With that, I complete. Arvind, you can step in.
Yeah, I'll just take a quick 30 seconds
Yes.
before Sriram gives his overview. I think quite clearly the government is trying to see how the learnings in the GST in terms of GST and implementation is being brought in. That's why you have punitive measures of withholding tax. Clearly, the exchange of information that's happening. So they're setting up a similar kind of system for direct tax provisions as well. I think the real compliance burden, what was stated was we'll try and bring down compliance, but we're actually making compliance a nightmare. And some of these provisions like reassessment, changing past positions, also there's a subtle aggression which is coming out clearly from these provisions. And that also seems to powers to the department to say that we are backing you, and a lot of these provisions are cherry-picked provisions. So when you see tax policy for a mature economy, these work on administration, they work on predictability. When you cherry-pick provisions and when you bring them after you thought like a quill, it was cast in stone. That's again a concern when we're looking at foreign capital coming in. They want predictability, they want stability. And when mechanisms for alternate dispute resolution within the Indian law, and when you're taking away a mechanism which was functioning well 10 years back, the authority purpose ruling, I think it really needs to be seen how the taxpayer charter actually find it being operationalized in a true sense. Over to you, Sriram.
Thank you.
Thanks. Am I audible?
Yeah.
Yeah.
Thanks. Thank you for a detailed presentation.
So,
my 2 cents.
Excuse me, sir, before you start, can I just introduce you?
Okay.
Yeah. Hello. Hello. Am I audible?
Yes.
Yeah, please go ahead.
Thank you. Thank you, Mr. Arvind and Mr. Vikram, for your detailed analysis, rationalizing the various provisions of the budget. You raised the bar with your presentation. Now, Mr. Vikram Seshadri, I would like to just introduce him before he starts. Mr. Vikram Seshadri is a partner in Pricewaterhouse & Co. LLP's tax and
Sriram Seshadri.
Sriram Seshadri, yeah.
Sorry, sir, Mr. Sriram Seshadri. He has over 25 years of experience in advising clients on Indian tax laws. He specializes in advisory and litigation. He extensively advises clients on international and domestic tax issues, helps structuring transactions, PE deals, and transfer pricing matters. He featured among the top tax controversy leaders in India in 2015 and was recognized as the top dispute specialist by the International Tax Review in 2014 and as a leading lawyer by Asia Law in 2014. He is currently the member of the General Committee of the Madras Chamber. He has successfully supported several government initiatives, appeared as knowledgeable witness before the Parliamentary Standing Committee of the Direct Tax Code. He conducts regular workshops on a number of tax-related matters under the auspices of various chambers of commerce in Chennai. He's also authored a number of articles in leading tax magazines and business dailies. He's a chartered accountant, cost and work accountant, and a law graduate. Our flagship program is never complete without you, I think, for 2 decades or more, sir. Over to you, Mr. Sriram.
Thank you so much. So, given the paucity of time, I would like to just focus on the philosophy of how this, budget has sort of transpired, and there is a common thread that runs across many budgets as well. One of the key things is that we always see a sneaky way of amendments that come in, through the fine prints, which is totally diverged from what the policymaker thinks and what the politician sets up as their, agenda. For example, as simplicity in tax laws or ease of doing business. Whereas what happens in the fine print is entirely the opposite, and which is what Vikram has nicely covered. And that is something which probably has to be highlighted by the chamber. And I don't know how we go about highlighting. We can't send a post-budget memorandum saying that there is a massive disconnect. But I think the way we may have to set this up is in private conversations. Because some of these amendments, when we go through and dissect and talk to the business community, it doesn't leave much to be desired. So I'll take 2 or 3 points which Vikram stated, but without repeating, whatever he said. Again, if you see the philosophy of how this thing has gone about, this government is extremely fascinated by this faceless assessment, which is fine at the assessment stage, because we all know the way assessments had gone about in the past. This will probably ensure a little bit better transparency, and being faceless helps in completing assessments for a vast majority. That is acceptable. It is an experiment, and we are going on a path to experiment this. But you can't have 3 layers of experiment. in this, successively. You can't have an assessment, an appeal mechanism before the CIT appeals, and again a tribunal mechanism. Everything is faceless. That is simply a recipe for disaster in my view, for many reasons. Some of you who would have experienced the tribunal, you obviously see and realize that they are the final fact-finding authority. Like Vikram said, we are going to be belaboring for many years before High Court for matters of law, but certainly matters of fact will reach finality with the tribunal. And therefore, in a tribunal, and fairly recently I had an occasion to argue for 2 days in succession on a matter which involved heavy amount of facts, and there is always a back and forth with 2 judges sitting together and hearing you. I cannot fathom 2 judges sitting in different parts of the country, starting to take up a case at different points of time, reading through whatever they want, ask you questions, which will come to me. I will respond at a different time. It will go to the judges at different points. They would be occupied with different things. This is just not feasible. This is not the way you can do a tribunal hearing. And that becomes complex, unlike a CIT appeals where there is a single person sitting. This is far more complex with two people sitting. And there are matters of urgency, like, for example, stay matters of urgency in importance, like rectification of orders, which will go to 2 different parties. All this is absolutely complicated, and this is absolutely unwarranted too, when we are only experimenting at the first stage of assessment, and we already have concerns of how the assessments are likely to go. I've heard of notices being issued under assessments of asking for all proof of all expenses beyond 1 lakh for companies which have thousands of crores of turnover. Shows the maturity of a concerned officer, because a matter of Chennai may be getting assessed in Ludhiana for all you know, and therefore the exposure levels of the officers will be very different, and we can't replicate it for 3 levels without seeing whether the first level is successful. So that is one major issue. Second, the articulation about the AAR. It is all well known that all the retired judges worth their name have more lucrative things to do after they retire, like arbitration. And nobody really wants to sit on AAR. That is a well-known fact. And therefore, AAR was getting delayed, but it still ended up to be a neutral body, and it was giving binding orders. And the law said 6 months, but it was taking 3 years, 4 years, and 5 years. While that is the case, if they wanted to repair this, it was an easy answer. They could have asked the chambers on ideas. In fact, we wrote in our pre-budget memorandum, we have sent ideas of how this should be improved. In fact, there was a recent Supreme Court ruling where the Supreme Court directed the government that AAR is the way to go, and you guys strengthen this. Now, if you are looking at strengthening it, I fail to understand how making it as a revenue body is strengthening it. They could have simply borrowed. All we needed is 6 judges, because there are only 3 benches, and we have so many tribunal members. We could have, because everyone is under the central government, you could have transferred 6 people to the authority for advance ruling, and they are already experienced in international tax and transfer pricing matters, so they will be able to adapt to the AAR environment. You can always backfill in the tribunal, because there is a tribunal filling is an annual exercise virtually. And that could have been easily done. It would have continued to be a neutral body, and it would have, with 6 members being there, disposals would have been faster. And in fact, I would urge the chamber to take this up, to write to them that this ought to be the suggestion, because globally, private rulings are the way to go to get the certainty. And in India, if you are to disband that in this fashion, it will be extremely detrimental. We are not setting up the right expectations. That is the second thing. The last thing is, I'm very perturbed by the fact that lawmaking is being relegated through rule making. If you see into this budget, there are, for amendments in Settlement Commission, Authority for Advance Ruling, Faceless Tribunal, and Dispute Resolution Committee. Everywhere, Dispute Resolution Committee, I'm just aghast. Which was said for smaller taxpayers, for resolution of the disputes, there is a committee to be formed. There is absolutely nothing in the law which gives away what this committee is to do, except that there will be a committee. Then the board will, give rules on how the committee will function. The only thing that comes out in the law is that they have the power to vary or reduce the penalty. How are they going to resolve the dispute? What is the nature of dispute which will go What are the ground rules of hearings? How will they pass orders? Is it like an appellate body? Absolutely nothing comes out of the law. Everything is subject to the board purview. And in all the 4 forums that we dealt with, tribunal, SETCOM, AAR, and the dispute resolution committee, they have added a paragraph to say that any modification, applicability or inapplicability of a provision of the act passed by the parliament will be given through rule making, that by a rule you will say that this provision of the act will not apply to this proceeding. That is so strange. You are just relegating the entire lawmaking to the Central Board of Direct Taxes to come through rules, and those rules will then to be followed for entire justice dispensation mechanism is not acceptable at all. So this is not desirable, and this is something which needs to be definitely changed. And this is the overarching things that I wanted to say. Maybe I'll just take 2 minutes to just touch upon 2 specific areas where the same thinking resonates. Take goodwill amendment. I'm not getting into the nitty-gritties of how the amendment works, but philosophically, if a taxpayer puts good money to buy business and he is paid an excessive sum because that business has the worth, and in his mind that he wants to pay that kind of money, and the tangible assets are much smaller, and therefore there is an intangible created. I don't understand why that intangible should not get a tax break in some form or fashion. The logic which the government has articulated, of course, even on purchased businesses where goodwill gets generated, is of course to say that goodwill may be appreciating in some cases, and therefore philosophically we don't want to allow a depreciation. Now, whatever name you call it, whether it is depreciation or amortization, or you could find a mechanism of giving a tax break. It is simply a case for an acquirer who has paid good money to acquire a business. For that person, for earning there is a real ROI, right? I've invested a certain sum of money, I have to get back something. And in setting up that ROI, somebody would obviously expect the capital that he has put in to fetch some sort of a break at some point in time, right? So if I've invested in a factory, I'll get depreciation. But if I've invested in intangible, I don't understand why I should not get a depreciation. It should be there. And quite contradictorily, especially when it is coming to international transactions, amortization of the goodwill, the government wants to treat it as an operating item of expenditure for the purpose of transfer pricing. And the Indian person dealing with a foreign party is expected to have a markup including goodwill, whereas that is not allowable for tax breaks. It's a clear contradiction in the philosophy of thinking. And the last point is the equalization levy. Again, while globally everybody is trying to see how they protect their tax base, and if someone is earning income from India and they want to tax it in some manner, because without a physical presence but through a virtual presence you make money, and therefore there is a growing concern amongst every economy. But the way the drafting of the law is, unfortunately, this has happened for a few years. Vaidhi also set out how it is poorly worded, and there are several instances in the direct tax proposal this time also where the lawmaking is really poor, the drafting is really poor. Today, the equalization levy problem is this, that we are sitting in an auto hub. Transactions between the parent and the subsidiary, not just for services, but for goods, also today has an exposure, notwithstanding the fact that there is a customs duty levy on the importation of goods. Because you are using a common ERP server, ERP packages, there is a real risk of some of these things becoming taxable. This was highlighted ad nauseum when the law was to be done, and the politics of this lawmaking was unfortunately playing out. And we all saw that the US trade representatives took a position that this is an unfair law, and so on and so forth. So the government dug its feet in to say that we are not coming out with any sort of a clarification. The only clarification which has come up is the point that Vikram articulated out of the 5 elements of contracting. If any one element of contracting is covered, it is all subject to law, subject to taxability. In other words, even if a payment is made, in other words, if just a purchase order is done. So what it really creates a problem is today, all businesses which are brick and mortar businesses, nothing to do with e-commerce, are to decide whether their importation of goods and services are subject to tax in India or not, notwithstanding there being an indirect tax. And this will all escalate into some sort of a massive constitutional issue and litigation around it. absolutely not warranted. If their intention was to tax e-commerce, they could have deferred to all the representation that went in, filtered out all the brick and mortar companies, focus only on the, like Arvind said, it might have been a bold step to only focus, on the e-commerce transaction and stick it out, rather than, creating this maze of doubts amongst people not knowing what to do with the compliance. That is where things have been left. So there is an opportunity to set these things all right, but none of this has been done. These are the disappointing aspects of the lawmaking, the budget making. Philosophically, there is a disconnect between the policymakers and the bureaucrats, and that is something which we'll have to focus on for sure, and also drive home some of these nitty-gritties as a part of our post-budget. I'll just pause with this, and I thank you for all the opportunity. Thanks for the chamber to have invited me. Over to you.
Thank you, Mr. Sriram, for summing up the tax provisions succinctly in your style that is always candid. Now we have the last speaker, but definitely not the least, Dr. M.R. Venkatesh. He's an advocate based in New Delhi, and he is an acknowledged expert in direct taxes and related regulations. He is a designated partner in Agastya Legal LLP and heads advisory and litigation. MRV, as he is popularly known to most of us, became a chartered accountant in 1992 and with an All India ranking. In 2018, he was awarded a doctorate by Shastra University, Tamil Nadu. He's also a visiting faculty in various professional institutions, chambers of commerce and universities across India. He's a regular panelist for prime time shows on national television and a well-recognized columnist in leading media publications in India. If you're game to read interesting articles, please log on to mrv.net.in. Over to you, Dr. MRV, and I'm also requesting Madam Saraswati to take over after this address. Thank you.
Thank you, ma'am, and thank you all. It's a sort of coming to the Madras Chamber. Of course, last year also I was there in the budget, but having shifted to Delhi, my frequency and visits to Madras Chamber, especially the Saturday morning meetings and exchanging of various thoughts and ideas are becoming rarer and fewer. And I yearn for those wonderful 2 hours of time which we will spend with various people, captains of Madras Chamber, give you get a good insight into what's happening and what's not happening to the economy. Now let me come to the subject proper. I think after what Mr. Ranade spoke so sagaciously, I think I would not be adding too much into the whole thing. But let me point out 1 or 2 things, and then I will close it out for the day. My mind goes back to the last year's budget, where the finance minister promised that we will end up with a fiscal deficit of 3.7%. That is for the year 1920. But in reality, we ended up with a fiscal deficit of 4.6% or 4.7%. In other words, on 1st February 2019, the finance minister could not foresee the reality that was staring at her, namely a stark slowdown in the economy. And that manifested, and in a way, I would say that COVID was a blessing in disguise, because as Mr. Ranade also pointed out, there were 8 successive quarters of growth slowing down successively. To that extent, the first quarter, the growth rate of 3.1%. So what is worrying me is that even if we bounce back and the V-shaped recovery happens, and it's happening quite fast in this country, we would be going back to the same growth rate of around 3.5%, 4% of what we had it in the first quarter of 2020. So my real worry is whether we will actually go on to a sustained growth rate of 8 to 9%. The entire statistics, whichever way you give me of the negative statistics or the positive statistics of 2020, I think that's an aberration year. We should not take any statistics of 2020 into consideration. So now coming to the budget proper, so let us see how this is going to accelerate. Now, one thing that struck me was the remarkable optimism that the finance minister has displayed while putting up the budget numbers. Tax this year says she will collect around 4.5 lakh crores, and next year she says she will collect 5.5 lakh crores, almost 20% up Direct taxes, she says that she will collect again more than 20%. Customs, she will collect more than 20%. GST, more than 20%. Well, there may be some logic that you can collect something more if you see that we will bounce back rapidly, and we are bouncing back. There's enormous buoyancy. There is enormous high frequency indicators that are suggesting that the economy is back on track. But core sectors, if you see, it is still tepid. If you see manufacturing, it is still in a very precarious state. In fact, the last 3 years, and this has not come for any great discussion even in the economic survey, and probably they don't want to discuss this matter. The share of manufacturing has fallen from 17% to around 15%. We have lost 2 percentage points in our GDP because manufacturing has not lived up to its expectation. And in fact, manufacturing sector is facing a severe problem, and I don't see any great ideas to tackle with that. The next one, which I thought was a big thing in the budget, was obviously the disinvestment, the monetization of assets, and the divestment program that the finance minister so eloquently brought through. But again, my mind goes back to February 1, 2020, where the Big Bang announcement of the IPO of LIC was announced, and that has not been carried out right through the year, and that is going to spill out through the next year. Whatever said and done, I understand fully that this is a COVID year, that COVID was there and government could not actually push it through. But disinvestment targets are never meant to be achieved. It is only an ornamental piece in the budget. It only wants, the finance minister wants to show that they want to liberalize, they are great reformists. But when it comes to actual reality, one joint secretary sitting in some ministry taking a green pen. And why a green pen? You must read Arun Shauri's governance and the scleros that are set in, and notes in the left-hand side of the file that this requires clarification of the law ministry, or this requires some detailed discussion, or this may attract CVC comments or CAG comments. That's all. The entire thing will be dynamited. All that it requires is 3 or 4 words by one joint secretary using a green pen to torpedo your disinvestment program. So asset monetization, disinvestment, they are talking about 175,000 crores. If it happens, I will be the happiest. But I can assure you, with the past track record, this is not going to happen. And let me take you through some of the points that she has mentioned. And the build-up to the budget was that it will be once in a century type of budget. I'm yet to find out, I may have missed something, but if somebody has been able to find out what was that once in a century thing that was there in the budget, I would be happy to be educated. Then there is the usual stuff that we have been talking about, all motherhood statements. The biggest motherhood statement was the Mitra scheme, to create world-class infrastructure for global champions in textile sector, leading to creation of 7 textile parks. Now, in the last 20 years, we would have seen these type of 6 parks, 8 parks on food industry, gems and jewelry, leather, again on various other sectors, but nothing has fructified. And for this, I don't see any budget allocation. And what is it that the government is planning to do? Is it going to acquire lands and construct buildings and say that, look, here is a textile park coming? I don't see. See, this, the problem with this is that it's a beautiful headline scheme. That thrust for textiles is there. The textile minister must have prevailed upon the finance minister to get some attraction and traction. But unfortunately, these are all not backed by any concrete schemes. Again, see this production-linked incentive launched to create manufacturing global champions across 13 sectors with amount committed to 1.97 lakh crore in the next year, starting financial year 21-22. So we don't know what is the exact allocation for these 13 industries, what is the schemes, which are the 13 industries, how much is being done this year, how much is planned to be done next 3-4 years. Hardly anything that is suggestive that there is some seriousness associated with it. Again, motherhood statements like hydrogen mission, Gaganyaan mode, we will send somebody. Then I find it very interesting. Of course, I like the intelligence of the markets, and I must confess, nobody can be far more intelligent in the market. The last couple of days, I've been finding that the stocks of many automobile companies going up. And one of the stockbrokers to whom I was speaking to was alluding to the vehicle scrapping policy. Then I asked him, isn't it voluntary? He said, yes. Then what if people don't do? He said he had no answer. But that is enough for the stock market to go up. That's the adrenaline that the stock market was looking into. Probably next couple of years, they may slowly, gradually truncate the years. They will say the voluntary scrapping automobile life will be scrapped to say 10 years, then probably 7 years if it is a commercial vehicle, and that's how they want to incentivize. But I suspect in India, whether you can really enforce, you may have a law, you can't enforce. Big thing that I saw in the budget as a positive was that they are going to look at the SEBI law and the securities law comprehensively, and that I thought was a very interesting piece of budgetary announcement, for one simple reason: the SEBI Act and as an institution brought in at the, and that was a reflection, not with great amount of thought process. SEBI Act has outlived and perhaps is 20 years behind the current developments in the market. I think there is a good need for us to revisit the SEBI Act, and I'm sure the Madras Chamber should actively participate in sending suggestions, because I saw speaker after speaker, especially Vikram, lamenting about this change from 6 years to 3 years under 147. Last year around the same time, I was in SEBI, and I was standing up for a company for whom show cause notice was issued for an act done or not done 18 years back. That was there is no limitation to SEBI. You know, they can call you for acts done in 20 years back, 15 years back. So perhaps we need to one of the biggest thing that we need to bring about is the certainty, and certainty will also start with limitation, and SEBI Act must get embedded with some sort of a limitation. And I hope that when they do a larger consultation, this will happen. Another thing that I found very positive in this budget was that after the conversion of IDBI, ICICI, and the three IDBI, IFCI, and ICICI into commercial banks, there was not any great amount of term lending financial institutions in this country. So what happened was the commercial banks took on themselves to lend for infrastructure projects, and infrastructure projects have been the biggest cause for the NPAs. So not because the promoters were swanky and the bankers were bad. That's a different story. But the point I'm emphasizing is the manner of evaluating infrastructure projects was not in line with the genetic makeup of the commercial banks. We required some exclusive bankers who do evaluation of infrastructure projects, and that's where I think the finance minister's announcement of setting up of a bank of with a corpus of around 20,000 crores and expecting that the loan book will go up to 5 lakh crores is something which is welcome. I think we have to also see to that these type of things are followed up. Again, like all goldsmith, like all milkmen who are entitled, the goldsmith mixes more copper than what is necessary. The milkman will mix water to the milk as a matter of right. The finance ministers, to ornament their budget, go on about talking about skill, about various other things. National Research Foundation with a outlay of 50,000 crore over 5 years. What does it do? Where does this money go? Where does it actually go about funding? What is the research? What is the output? Who is the beneficiary? All of this we don't know. Likewise, we have this very interesting thing about fisheries. There are 5 fisher harbors that they're planning to come about, bring about in the whole of India. 4 on the east coast, and if I memory serves me right, 1 on the west coast. Now, these along with cold storages, then along with value chain institutions that will ensure that the fishes are processed and export, if they are all linked and made as a package, I think then this does make sense. But I don't know where they are going to bring about the fishing harbor in Chennai. Probably they are going to divest Chennai port and convert it into a huge fishing harbor, which is welcome in the sense that that's a good idea to look about it. Then the usual stuff about PPP, managing through PPP and skill, because skill management, using people, engineering diplomas with the UAE and Japan in area of skill development and recognition, and doing all these things. We all know that Narendra Modi started with this Skill India, then about talking about your Namami Gange. Now you talk about your smart cities. Then you talk about Make in India, Made in India. All these, nobody talks about it. People have known that these are all buried fathoms. These are all things that even Narendra Modi has given up. People have not. People have realized that these are all mere empty slogans and nothing much is happening at the ground level. Coastal India, to develop some Sagarmala projects, to use the entire coastline of India. All these are, enormous rhetorics that has happened. But finally, nothing has, or substantially nothing has been delivered at the ground level in these projects. So all these, I won't care much about it, except the fact that these are all the usual stuff in the budget. Now coming to the two important tax provisions that people have been talking about. One is, of course, the change that they have brought in the tribunal, which will be basically a faceless scheme, as Vikram explained and Sriram alluded to in greater detail. I would only think that whether it will meet the standards of Article 21 is a question that we need to look at. And my biggest worry as far as 147 is concerned is even an article in Nakiran may be an information for the purposes of reopening and assessment. And I would only now look at the way the department may use various type of information, because people we are practicing on the Benami law, we see that any type of information is being used to label somebody as a Benami person, and where the same standards of information are being used. So I think that the Benami law now, becomes the elder brother for the income tax law, and the information standards that are being held by the department in terms of issuing notice under the Benami law will be extended to the reopening of assessments. So with this, I would like to say that there is overall facts of the budget is that for some reason that the experts have not been able to decipher, markets have somehow or the other found reasons to cheer. And if there is a suspended sense of disbelief that you have to face your reality in life, and people are in a suspended sense of disbelief and in jubilation, I don't want to disturb their euphoria, for lest I will be looked at as a fool. And being a practitioner of the world's ancient dismal science, namely economics, I would not venture and let the euphoria die down. Let them realize that the fine prints as they hit people. Let people realize that the expansionary drive of the finance minister actually will result, and most likely to result, in the weakening of the currency, and probably a weakened currency could spiral inflation, and that could be a major disaster. But that is something that the finance minister had to gamble, give it to her, that she had a choice and she had to do this, and we run a risk of around 6 to 7% depreciation of the rupee in the next 6 to 8 months. With this, I will stop, and thanks once again to the Madras Chamber for hosting me, because this one pilgrimage that I wouldn't like to miss at any cost. Thank you all.
Thank you so very much, Mr. M.R. Venkati. Probably soon we will meet in person and discuss a lot the budget. Are you able to hear? Am I clear? Okay. So I think
we are missing.
My,
Now it's clear. You can go ahead.
Yeah. Thank you, Dr. We never liked especially in our budget workshop. The trio has to be there to make it come. Thanks for joining at such a short notice. And probably, as he says, with all the social media active and all the statistics coming from all sources, we don't know which to take, which to leave. Probably, I will also use a Thiruvalluvar's words. If FM can use, I also would like to use and say, Epporul yar yar vai ketvenum, apporul meipurul kanbad arivu. Maybe we'll have to wait a little more to know the meipurul of this budget. People like Emma, we can also decode that. So thank you so much. It's your inimitable style as usual. And we are again very happy and thankful to you for joining. 2 questions we can take before we close it because we have overshot the time. Just probably 1 or 2 questions, and then I will leave the floor to Mr. Keshavan, Vice President, to propose the vote of thanks. And I would request all the panelists to stay back for a minute more after it gets over for a group photo. Any question from anyone? If there are no questions, I will turn to Mr. Keshavan.
Thank you, Saraswati. I think, first of all, let me thank Ajit Ranade. I don't think he is there, but his opening remarks actually gave me some kind of hope that something is God sent. But I think subsequently our friends have made it that the devil is in the details. So I think we need to really see how things are going. But I think I need to really thank all the panelists for coming here. Let me start with Vaiti. One thing he has made it very clear. He says, Padittal mattum poduma poda, the cinemaum bakano, OTTum bakano. Otherwise, I think there is, you will not understand this budget. So I think he mixed it very well. So, sir, cinema papo, I think most of the people understand Tamil, so we do both. But I think it was a very interesting presentation. So let me thank you for what the kind of presentation intermingled with the cinematic things what you have put in. Then I think we had Mr. Aravind Srivasan as along with Vikram Vijayaraghavan. There also I remembered a movie Tenali where I think he talked about bhayam. Wherever I go, I'm a little more afraid. And that is where I said devil is in the details. So I think they also made it that new better may not be a better idea. So let's wait and see. I think a lot of things we have to really wait and see. That's what I also still believe. But I think it has been an excellent presentation. I think you chaps covered all the important areas where you find there have been disassociations from the past, which cannot be all that good. But there have been a few areas I think things have been, can be looked at as the right things done. It has been added by Mr. Sriram Seshadri. He talked about the faceless. He said you can be faceless, but you cannot be a Trimurti of facelessness. And I think that is a very, very interesting thing to think through. You cannot go through 3 faceless levels by the time you really try to get a solution. And tend to agree with him that policymakers and bureaucrats, there is always a divide. Then I think Mr. M.R. Venkatesh came and he talked about disinvestments and targets and ornamentals are ornamental. And I don't know whether he made the pun intended that when he said that FM makes motherhood statements. I presume it is not pun intended. And he also talked about all the parks are just smoke and no spark. So we'll have to wait and see. That's what I said. We need to really wait and see what's happening. But I think every one of you, right from Vaiti to Aravind, to Vikram and Sriram and Mr. Venkatesh, I think we need to really thank everybody. I need to thank the media and the journalists who are present in this. I need to thank the entire chamber secretariat, including the president, to the secretaries and the people involved in this. I know they have put in a lot of efforts. And obviously, I cannot forget the participants. And once again, thanks a lot for joining in and making this a very successful event. I think we have made a lot of notes on the inputs provided, which I'm sure we'll be able to use it in our official life a lot to understand how we need to work out our own strategies and policies. Thanks a lot, and thanks to all of you once again. Thank you.
As I
Voice.
To unmute your video and come for a group photograph. The panelists and the general committee members who are present, please join for a quick group photograph. Mr. Srivatsam, are you there?
Yeah, I'm here.
He's there.
Okay. Okay. Request all of you to switch on the video for a minute for the photograph.
Only panelists now.
Panelists and of course.
Audio is open to all.
No, video is only for the thing. Audio is also muted. Video mainly for the panelists and the general committee.
Maybe for your videos on. Okay.
Yeah, you can just have your videos on.
So, Srivats, you now understand what we went by wow when we are listening to some of those aspects. Wow has got a different meaning.
So the OMG is also explained.
Yes, OMG is explained. Raghu must be happy now.
But unfortunately, Sriram couldn't join, I guess. I just sent him a message whether he can join.
He said he'll go on a call. No? He said he has to exit a bit.
I just asked him whether he can join for a minute for the photo. Okay. Who's taking it, by the way? Madhu? Somebody's taking it? Suresh or someone from the office?
Yeah. Ma'am, you're not on video. We're not able to see you.
Okay. That have been too visible.
Yeah, we got it. Thank you.
Thank you very much.
Thank you. Thanks, everyone. Thank you so much.
Thank you. Thank you.
Have a good day.
Bye all.
Bye.
Thank you, Saraswati. Thank you very much.
Thank you. Thank you. Thanks, Venkatesh.
Thanks.
Chennai, you have gone back to Delhi, is it?
Yeah, I had to come back here for some work. So.
Okay.
Yeah. Thank you.
Okay.